Mic testing, mic testing. Hi guys, how are you doing? Yes, so let's begin. So today we will be doing an interesting area of buyback and ESOP taxation. Okay, these are very interesting areas, both buyback and ESOP taxation. So let's get on with it. All right, guys. So buyback, come to page 02. If you remember, the previous time we had done liquidation when we did 46.1, 46.2. And then we'll say we'll come back to this later, I told you. Now we are coming back. Please come to O2, right? And yeah, all this intercorporate dividend, all that we previous class we finished, guys. Buyback O2. Guys, buyback of shares is governed by Section 68 of Companies Act, right? Section 68 of Companies Act. So before we go into the tax part of it, let's see, how a company can buy back, what it can do. Many companies have bought back, Infosys, Wipro, TCS, regularly they do buy back shares. Why do they buy back shares? Basically, if they have adequate funds and they have already given dividend, and also the fact that they have invested everywhere and still they have excess funds. So of course they are going to buy back the shares in such a manner that, people will obviously feel that the company is doing so well that even after, so much money also they have the funds with them. So that's how it works. That's why they're buying back the shares. So obviously eventually what will happen is the share prices will go up. So guys, in Companies Act, Section 68 talks about it. In the previous class only we discussed, notwithstanding anything contained in this act, which means what? This section overrides all the other sections. So I told you this section overrides the reduction of capital section also, right? So if you buy back shares, ideally it will be reduction of capital, no? Like for example, I have 1 lakh shares. I bought back 20%. So now it is 80,000 shares. Isn't it reduction of capital? Yes. But Section 68 says it will not amount to reduction of capital. But subject to the provisions of subsection 2, that so company may purchase its own shares. Shares here means what? Equity and preference. But it is not preference, because for preference shares, another section is there, 55.2 in Companies Act. 55.2 is redemption of preference shares. So this predominantly is what? Equity shares. Since there is a specific section for preference shares, 55.2 in Companies Act, for equity shares, it will be section 68 or other specified securities. From where can I take out? I can take out from free reserves. I can take out from security premium account or proceeds of issue of any shares or other specified securities. So guys, if I have free reserves with me, free reserves, I can take it out from there, or I can take it out from securities premium account. Securities premium account is like a quasi capital. So if a share is valued at 100 at the premium of 80, 20 rupees is, let's say, the face value and 80 rupees is the premium. So basically it's like you're paying something extra for the shares. That is called as securities premium account, as you know. So I can take it out from my free reserves or from securities premium account or the proceeds of any of the issue of any shares or other specified securities. I can make a fresh issue of shares, is what they say. Provided that no buyback will be made out of proceeds and early that you leave. So the buyback should be authorized by the Articles of Association. You should pass a special resolution at a general meeting. So before that, of course, since you're buying back shares, you should also pass a board resolution. Then it should be mentioned in the Articles of Association that buyback power is given. Then you should pass a special resolution. Special resolution means 75% majority. Then all those things, 25% of the aggregate capital should be maximum. Ratio of the secured and unsecured debts after buyback should be, maximum 2. This talks about the debt equity ratio. Debt equity ratio must be maximum 2. Then all other shares should be fully paid up. Buyback of shares or other specified securities listed on a recognized stock exchange in accordance with the SEBI regulations. And the buyback in respect of shares or other specified securities other than those specified, all those things must be given. That other things you leave, that's what it is. Now, where can I buy back from? I can buy back from existing shareholders or security holders on a proportionate basis. I can buy from the open market, from the stock market. And we've always been telling stock market, off the market, stock market. Off market transactions means without the market being there. Then by purchasing the securities issued to employees of the company pursuant to a scheme of stock option or sweat equity. So those people who have already got ESOP, stock option or sweat equity, I can buy back from them also. So in this session, we'll be doing both ESOP taxation when you give stock option and when you buy back also. Can you buy back from the same guys to whom you have given ESOP? Yes. Or can you buy back from other people also? Yes. That's what this section says. That's all is there to it. Now, for our income tax purposes, there are two sections. One is 46 capital A. Other one is 115 QA. 46 capital A is one, then 115 QA is the other one. So if you see guys, 46 capital A. Capital gains on purchase by company of its own shares or other specified securities. The same wordings that you saw in section 68 of Companies Act. That's why I take you to Companies Act also, because it becomes easy for you to understand. Where a shareholder or a holder of other specified securities receives any consideration from any company for purchase of its own shares or other specified securities held by such shareholder or holder of other specified securities, then subject to 48, the difference between the cost of acquisition and the value of consideration received by the shareholder or the holder of other specified securities shall be deemed to be the capital gains. So the cost of acquisition and the value of consideration received by the shareholder. So whatever the cost of those shares minus the actual value that is received by the shareholder will be the capital gain. Now guys, this was section 46A. If you see specified securities, if you see, it is similar to section 68 of Companies Act. That's what we had seen now. This will be as per the MCA, whatever they prescribed. So guys, earlier, no, this section was there for listed companies. And for unlisted companies, we had 115 QA. See, tax on distributed income for in case of domestic company. Notwithstanding anything contained in any other provisions of the Act, in addition to income tax chargeable in respect of total income of a domestic company, any amount of distributed income by the company on buyback of shares. Now you see here, not being shares listed on a recognized stock exchange was there. So 46A was for listed companies. 115 QA was for unlisted companies. That has been removed when? From Finance Act 2019. Which means from Finance Act 2019, 115 QA also will be there. 46A also will be there. To ensure what will apply, they have made it very clear in the proviso. Provisions of this subsection shall not apply to such buyback of shares, being shares listed in respect of which public announcement has been made on or before 15th July 2019. So guys, even though section 46A has not been deleted, it is still there. But because of this insertion in 115 QA, because of this proviso, section 46A has lost its significance. Yes or no? Yes. That's why if you remember there, I didn't even do it. I just read it. I didn't even actually teach. I just read what is there. Because as of today, though the section has not been deleted, because of another proviso in some random section 115 QA, what has happened to section 46A? It has become redundant. There are many such sections in Income Tax Act where because of this section that has been redundant, that has become redundant. So that's what we need to understand. Right. Let's see. Same if you see, many means purchase of a company by buyback of its own shares with the provisions of any law for the time being in force related to companies, which means Companies Act only, section 68. So if the share issue price is, let's say, 1000 rupees and the company had initially issued it at 300 rupees, so what would be the tax? Tax will be on 700 rupees. Very simple. That's how it works in 115 QA. There is a fixed percentage, 20% plus surcharge, etc. That is the percentage that is given. That's it, very simple. And this income would be exempt in the hands of the shareholder. Because the company is paying tax, at the hands of the shareholder it will be exempt. Now, is this deemed dividend? Tell me, is this deemed dividend? No. In the deemed dividend section, we had clearly seen in the exclusion that buyback. Remember guys, deemed dividend. Sir, when do you did deemed dividend? Sir, I don't remember only. Hey, nonsense fellows, we are done guys. Come on. Section 222. In that 222, dividend includes ABCDE. Then dividend does not include ABCDE. In that ABCDE, this thing was there. Swami Nityananda Swaha. It's not working. Swami Nityananda also is not able to do anything with this today. Okay. The sun was sleeping. Just like that internet was sleeping because Swami girl was walking. That fellow I told in one of those videos. Today I came 5 minutes late. That's why the sun also came 40 minutes late. Like that one dialogue you had put. Yes. Dividend includes ABCD. Then dividend does not include. There. Any payment made by a company on purchase of its own shares in accordance with this. So basically this is not deemed dividend. So the gist of the story is, my dear friends, gist of the story is what? Buyback. Company will pay tax. Company will pay tax. Very, very simple. At what rate? 20% on distributed income. 20% of distributed income. Plus 12% surcharge. Plus 4% health and education cess. So overall comes up to 23.296%. It is fixed. Company will pay tax undoubtedly. Next, what will happen? Exempt in shareholders' hands 1034 capital A. Distributed income is same, that is given there. Generally the buyback price minus issue price. And not deemed dividend. It is clearly given in the exclusion. It is not deemed dividend. That's the gist of the story, guys. Check it out. So this is 46A, 115 QA, both for listed and unlisted. And listed is from 2019. So amount received by the company in respect of issue of share, the share issue price, etc. will be determined as per Rule 40 BB. So the most important thing in this particular thing is nothing but Rule 40 BB. How it works and all we should see. That's it. Come back, guys. Come to this page number 0.2. Where a company purchases its own shares or other specified securities, the difference between the cost of acquisition and the value of consideration. Yes, so we have seen here 23.296%. You should remember this part. as referred to in section 1 QA, and then shareholders 1034A. PJ Limited issued 10,000 shares at 110, face value 50 on 14/7/2017. On 25/6/2022, PJ Limited decides to buy back 5,000 of its shares at 500 rupees per share. In this case, how much will it be? 5,000 shares I'm buying. 500 minus 110 issue price into 23.296%. So 4,54,272 capital gain will arise. Shareholders will be exempt from tax in case of a buyback. If the listed shares obviously are held for more than 12 months, then the benefit of indexation is available. In this case, I have not considered it, but yes, benefit of indexation is available. Specified securities include employee stock option also, another securities notified by CG. The company is required to pay tax to the government within 14 days from buyback. Very simple. As per section 115 QB, if the tax is not paid within 14 days, then the company will be required to pay an interest at the rate of 1% per month or part thereof for the expiry of 14 days. As per 115 QC, the company fails to pay the tax, company will be treated as SSE in default, and all the provisions of SSE in default which we had seen will come to this particular case. Very, very simple. Now, this is the thing. 40 BB, determination of issue price. Scenarios under which issue price can be determined for the purpose of buyback. So this is important. They can ask you an MCQ and all those things. How will you determine, etc. This can come. First, share issued by a company by way of subscription. So issue price shall be the amount received by the company including securities premium account. So ABC Limited issued shares of face value at 10 at a premium of 80. In this case, what will be the issue price? Obviously, it will be 90 rupees. Including premium, I should do it. So basically, today buyback price was 300. So what will this be? 300 minus 90. Very, very simple. 300 minus 90. And one thing to understand here is, guys, this surcharge, etc., has to be paid even if the company's total income is nil. So I told you, surcharge 12% and 4%. You can write down here only. I'll write here actually. This one. This has to be paid. It is mandatory. It does not depend on total income. Doesn't depend on total income. So if this company has taken some, ATIA deductions and all, it has gone to Northeast and built one hotel, all this, the total income is nil, then and now it's buying back shares, then will surcharge not apply? 100% it will apply. So instead of this, you can just remember 23.296%. Please remember the rate, 23.296%. So come to this. This is sub rule 1. Rule 40 VB 1. I'll write here 1 so that example will be for 1. So for instance, PQRS. For instance, let's take PQRS. P. So the company issued these shares, 10 lakh shares at 10 each. For Q, 10 lakh shares at again 10 each. 10 lakh shares at 10 each. Premium of 20 each. 10 lakh shares at 10 each. Premium of 20 each. Company is buying back how much? 1 lakh shares each at 50 rupees per share. So what will be 115 QA? PQRS. 1 lakh into 50 minus 10 here. 1 lakh into 50 minus 10. 1 lakh into 50 minus 20 plus 10, 30. 1 lakh into 50 minus 30. So it is 40 lakh, 40 lakh, 50 minus 30, 20, 20 lakh, 20 lakh. Overall 1.2 crore. This 1.2 crore into that percentage, 23.296%. Tomorrow, if this is before this buyback, if company reduced 10 rupee share to, let's say, 8 rupees and 5 was bought back, then what should I do? If they reduce the capital, it's possible, no? Face value of 10 each has now become face value of 8 each. Correct? They have reduced the capital. Reduction of capital has happened. Very much possible. Then they have made it 5 rupees was bought back. Then what to do? Will it become here 50 minus 5, 50 minus 5, 50 minus 25, 50 minus 25? Will it become like that? We'll see. We'll see this. So guys, check that next rule, you'll understand. Issue price, see this, sum out of amount received returned by the company prior to buyback. There is a reduction of capital. Then issue price shall be reduced by the amount returned by the company. In the above example, if the company returned 10 rupees prior to buyback, issue price will be 90 minus 10, 80. If the company has paid additional income tax under 1150 on returned amount, then it shall not be reduced. This, I'll give you a better example than this. Same, all these things. 8 rupees it has become, and then 5 rupees we have given. Now, it all depends on one thing, as you know. If reduction of capital has happened, fair enough. What is the distribution that has happened? What is the distribution? Value of shares, they have reduced from 10 rupees to 5 rupees. So what is the distribution? 5 rupees has been distributed. 5 rupees has been distributed into what would be the shares? 4 lakh, correct? 4 lakh. The shares are actually, one second. Sorry guys, 40 lakh I told you, no? 40 lakh. 1, 2, 3, 4. What I am saying is 40 lakh shares were there, 5 rupees cash has been paid. 2 CR. 2 CR. Now I need to see. I have already distributed to shareholders. If reserves and surplus of the company is greater than or equal to 2 crore, then what happens, guys? This will become deemed dividend. If you remember, deemed dividend is always to the extent of the reserves and surplus. So if the company has reserves and surplus greater than or equal to 2 crore, then this entire 2 crore will be deemed dividend under 222D, taxable in the hands of the company. Sorry, in the hands of the shareholder. That is done. And here, capital gain for company would be what? There would be no change. There would be no change. It will be the same. Because the person has already paid the tax, because shareholder has already paid the tax, here I will not subtract that amount. Think about it. If I subtract here, then this will increase. If this will increase, it will result in double taxation. That is not, preferred. So, if taxable in the hands of the shareholder, CG for the company will be same as discussed. I'll put 1 star. Which star here? This star. Same. No change. But if reserves and surplus are, let's say, nil, if reserves and surplus are nil, then there is no deemed dividend, no tax for shareholder, capital gain for company. So guys, tax has not been collected from shareholder. So don't you think so? These people should pay more tax. Which company should pay more tax? Yes. How will the computation look? It is not taxed only. What is not taxed? Deemed dividend is not taxed. So for PQRS, for P, it will be what? 1 lakh shares, 1 lakh shares, 1 lakh shares, 1 lakh shares into. Initially, a buyback price is 50, but now I will not take it as 10 rupees, I will take it as 5 rupees. Because here I am reducing, the difference will become more. The difference will become more, tax will become more, obviously. So this will become, instead of 40 lakhs, 45 lakhs. Same. This is what? 50 minus, instead of 30, 50 minus 25 it will be. This will become 25 lakh. And this also will become 25 lakh. Overall, how much, guys? 1.4 crore. See? $1.2 crore has increased to 1.4 crore. On this, there will be tax. 23.296%. So the reduction will happen when? When will the reduction happen? What is the thumb rule? If prior to buyback, company had given money to shareholders and it was charged to shareholder as deemed dividend under 222A, B, C, D, E. Then in 115 QA, do not reduce issue price. Do not reduce issue price. But if it was not charged to tax. That is no deemed dividend. Under 115 QA, need to reduce issue price. This would be the thumb rule. This would be the thumb rule. Very, very simple. Okay, come on, fist pump, come on, guys. Did you understand? Thumbs up, all of you. Great. Easy, easy, easy. Don't do heavy duty stuff. Yeah. Shares issued under ESOP or sweat equity scheme. So issue price shall be the FMV of the issued or amount credited to the share capital including security premium account, whichever is less. So ABC Limited issued sweat equity share of face value 10 at a premium of 80. FMV of such shares on the date of issue was 100. In this case, issue price shall be FMV of the shares 100 or the amount of share capital including security premium 90, whichever is less. So therefore it is 90. So I would have issued whichever is less, I should take FMV or the other one. So in ESOP, what happens? Though we will be doing ESOP taxation next, but just for the thing, ESOP. So obviously it's a stock option plan. So initially they will ask you to, they would give you the option that if you work for 2 more years, then you will be eligible for the shares. And then you can choose either to buy or not to buy at that predetermined rate. If you choose to buy, finally we will allot the shares. So this eligibility, this waiting for 2 years is called vesting period. Eligibility is on the date of vesting and then allotting. FMB will be here also at the date of the option. FMB of the shares, let's say, is 1000 rupees. Here it becomes 1200 rupees. The day of allotment is 1400 rupees. What should I take is the question. So you see, so that will be as per rule 3.8, which we will discuss in ESOP taxation, that you leave. But here coming to that, we are now not talking about taxation of ESOP for them. We are talking about for the company. Let's discuss that. So if an Infosys employee gets an employee stock option plan, let's say he gets it at nil, free he will get, or he will pay, let's say, 100 rupees. The FMB as computed under rule 3, which we will see later. Today only we will see, this class only. 2000. Here also it is 2000. What would be the perquisite? So guys, this will be in the hands of the employee, a perquisite. So here it would be obviously 2000 will be perquisite. Here it is 2000 minus 100, 1900 would be perquisite. So I'll say ESOP slash sweat equity. Because this, when I say nil, this is the sweat equity. Generally, it is for consideration other than cash. So this will be taxed as a perquisite in the hands of the employee. We are not even talking about that. We are talking about what? We are talking about what if these shares are bought back. What if these shares are bought back? What will be the tax on the company? I showed you section 68. That's why I showed you. The buyback can happen from the open market, or it can happen from those where I've already given as ESOP and sweat equity. That's why I showed you, right? So now let us discuss from the company's point of view. Okay, don't get confused. This is what ESOP taxation. This will be handled in ESOP taxation immediately after this session. In this session only, immediately after discussing this concept. Which concept? We are doing rule 40BB, right? Now, let us talk about if the company now buys back this ESOP. Like for example, this fellow or sweat equity, this fellow has got 2000 rupees, this guy at 1900. Let's say they pay 4000 rupees. What would be the, what do you say? Tax is the question. So that's what the difference that FMB, or if you see the FMB or the, here you see share capital including securities premium, whichever is less. Anyway, give an example because little bit a split also has to be made. Check it out. See there, those examples are for one day before the exam. That's why I've given in the book. Everything we can't put in the book, guys, because that book has been designed solely for, 1.5 days before the exam. But everything else will be done in class, as you've been seeing, which will actually give meaning to that book in a much, much larger way, right? So let's say, suppose a company issued ESOP or sweat equity. 10,000 shares to Mr. A at rupees 100 per share, being the face value. Fair market value as on date of exercise of option is 1000 rupees. So what is the perquisite, as I told you, in the hands of the employee? 1000 minus 100. Already discussed the same stuff. 900. 900 into 10,000 shares. 90 lakh rupees. Fair enough. Now, the company, little bit of accounting also will come. Company can pass the entries in two ways. Case number 1, case number 2, accounting entry. One, ESOP expenditure debtor, 90 lakh because this is expenditure. Bank account, 10 lakh because I'm getting this, 10 lakh. 2, share capital account, 10 lakh. 2, share premium account, 90 lakh. The other case, direct bank account, 10 lakh. 2, share capital account, 10 lakh. Direct. Here, I'll write company wants to buyback price 1300. So in this case, guys, it will become what? Share capital and securities premium, both it will be. So distributed income will be what? 1300 into 10,000 shares minus 1 crore. 1.3 crore minus 1 crore, 30 lakh. So 115 QA will be on 30 lakh. On the other hand, here distributed income will be what? 1300 into 10k minus 10 lakh. So company will pay what? 115 QA on 1.2 crore. So it should be on what, guys? On FMV? It is 1000 or 100, whichever is less. So ideally speaking, this is correct. This would be wrong because, first of all, this is what they do for tax planning. Because it's a share capital or security premium account for tax planning, all this golmaal they used to, they kept doing. Come to this, I'll show you. See, the amount credited to the share capital and share premium account by the company shall be deemed to be the amount received. Shall be deemed to be the amount received. So what the companies used to do now? They used to claim this also as an expense and pay this also at a lesser rate. What they have done now in certain rules, and also this particular thing has been disallowed. Income Tax Act. When you come to ESOP taxation, we will see. The moment that is disallowed, there is no point in adding this entry. It's not an expense, first of all. So if you disallow, they will never pass any of these entries like this. So they will pass this entry only. So what will become easier? This one. 1115 QA on 1.2 crore. That's the reason why I have written whichever is less actually, because this tax planning left side should not happen. That is wrong tax planning. Got it, guys? Very simple. Next. Shares issued in the scheme of amalgamation in lieu of the shares of the amalgamating company. Very simple. One company is, you will getting shares in the other company. What would be the same? Maple Limited amalgamated with Thunder Limited. Thunder Limited issued 2 lakh shares to the shareholders of Maple Limited. Maple Limited had issued 50,000 shares of 28 each amounting to 14 lakh. Issue price shall be 7 rupees per share. How? 14 lakh divided by 2 lakh. Because earlier, guys, I had 14 lakh. Now I am getting what? 2 lakh shares. So what would be the share? 7 rupees per share. Simple math. So let's take one more example. Mr. P acquired 10,000 shares of PJ Limited at 20 per share. PJ Limited got amalgamated with KG Limited, and Mr. P is allotted 30k shares at 10 each in KG Limited. KG Limited now buys back 5,000 shares at 15 each. Very simple. So guys, how much did Mr. P invest 10,000 shares into 20? Basically, he had invested 2 lakh. That's all there is to it. How much is he getting from KG Limited? 30,000 shares is getting. So what would be the actual, value for Mr. P in KG Limited? It would be 6.67 per share. 6.67 per share. Very simple. Now you see. Distributed income, same stuff. 5,000 is buying back at 15 each. Minus what is the issue price? 5,000 shares into 6.7. That's all. This will be the distributed income. Distributed income definition is the same only. Buyback price minus whatever is given. That's the same. That is not changing. Everything else is changing. Simple. Same logic for demerged company. But in demerged company, what do you say? This will come. Shares issued by the resulting company in the scheme of demerger. Amount received by the demerged company for the issue of share into net book value of assets transferred in demerger, net worth of the demerged company before such demerger. For the demerged company, amount received by the demerged company for the issue of shares minus amount determined for the resulting company. See here, you'll understand this. ABCD Limited issued 1,000 shares of 600, face value 100. During previous year 2023, D Limited was a resultant company formed after demerger of ABC Limited, now the demerged company. D Limited issued 500 shares to the shareholders of ABC Limited. Total assets transferred during demerger were 100 crore. The net worth of the demerged company prior to demerger was 400 crore. In this case, issue price for the resultant company shall be what? 1,000 shares into 600. What was there before? Into what? How much of the net book value was transferred in demerger? 100. Correct? 100 crore. Out of 400 crore was transferred. This was the overall share value. This was the basically 1/4 of the company is transferred. So what would be the issue price of the resultant company? Obviously, overall value of the company into what part of value that was transferred. That is this much. So now issue price per share will be what? It purely depends on how much shares were issued. 500 shares were issued in the demerger. So 1,50,000 by 500, 300 rupees per share would be the basic issue price. What is the issue price for the demerged company? Overall 6 lakh was there, in which resulting company took over 1,50,000. So the demerged company 4,50,000 is allowed. And what is the issue price for the demerged company per share? Same, 4,50,000 by what is the shares which were there before? 1,000. So it is 450 per share. Very, very simple. Value of the resulting company is 1, value of this company is 1. So wherever I am receiving, that person should do the same thing. This we will also discuss when we do demerger. Separate chapter is there. You will understand there this calculation again. So it's very simple. So if you see, share issued by the resulting company in the scheme of demerger, for the resulting company is what? For the demerged company is what? In this, the resulting company is D Limited and the demerged company is ABC Limited. So first I have to compute issue price of the resultant company. Overall shares 1,000 into 400, 600, sorry, the market value. In that, how much part is demerged? 1/4. 100 by 400, 1/4. So 1,50,000 is demerged. That is the resultant company. What is left in ABC? What is left in ABC? Obviously, overall value 6 lakh minus the demerged portion 1,50,000. So 4,50,000 is left. So what is the issue price for the demerged company? 4,50,000 by 1,000. What about issue price for resulting company? 1,50,000 by 500. Very, very simple. Very, very simple. Bonus shares issue price will be nil. Guys, this has become fully redundant actually. Point number 6 not needed, redundant. 7 redundant, useless it is. 8 done. 9 redundant. 10 will do. Shares are brought back which were held in dematerialized form and the same cannot be distinctly identified. We have discussed it should be based on FIFO. ABC Limited issued 100 shares at 50 on 10/4/22, 200 shares at 55 on 15/4/22, and 300 shares at 60 on 24/22. ABC Limited decides to buy back 500 shares. In this, issue price per share will be determined by FIFO method. How? In this 500 shares, first one I will buy. How much? 100 at 50. Next, 200 at 55. Then I need only 200 now. 200 out of 300. So 200 into 60. Issue price shall be the face value of the shares. Alright guys, please come to D18. Please come to D18, income from units. It's a very small thing, we'll finish it off, income from units. Very easy. So similar to dividend, any income received in respect of. So what used to happen was, one second. Income from units. So prior to 2020, income earned by mutual funds or income earned by unit holders. Income earned by mutual fund was taxable at the rates under 115R, whereas by unit holders were exempt under 1035. So income earned by these mutual fund houses, etc., is taxable for them under 115R. So after 2020, Finance Act 2020 brought about this change. They said, now let us change the entire deal and let us make it chargeable to whom? To the shareholders, the unit holders. So after that, after 2020, units, that is the income earned by mutual fund houses is now exempt under 1023D, new section. Just like dividend, guys, is also changed. Then by unit holders, it was taxable at applicable rates. Taxable at applicable rates. Unit Trust of India, UTI, after the Ketan Parekh scam. Ketan Parekh, he was a, what do you say, protege. Protege means is, what do you say, Shishya. Shishya of whom? Harshad Mehta. Ketan Parekh scam in 2002. So this Unit Trust of India lost lot of money, guys. So Unit Trust of India Transfer of Undertaking and Repeal Act was formed in 2002. Unit Trust of India Transfer of Undertaking and Repeal. So UTI was repealed and this law came into force. And UTI became two parts. One was a specified company One more was administrative company, administration. UTI administration had all the children's scheme. All the children's scheme went to that. All the children's scheme went to that. Now, how much income, what do you say? How much expenses can I claim? And all these income from units, etc. for unit holder. After this one. This will be taxed where? Under IFOS. That is why this chapter here, IFOS. Mutual fund, specified company means what? UTI. Then administrator, UTI. Shall be chargeable in the hands of the unit holder under the head other sources. Reduction in respect of dividend or income from units. From the amount of dividend income from mutual fund, no deduction for any expenses shall be allowed except for interest expense. Such reduction for interest expense shall not exceed 20% of the amount of dividend income from the mutual fund. Mr. A received dividend from ABC amounting to 20 lakhs on 28/3/2020. He has borrowed sum of 1 crore. So now we'll come to that. You have borrowed money for that. So will you get interest? So guys, all that is given in section 57, right? So expenses. Investment of units of, one is mutual funds, one is specified company. One more is what? Administration. So what expenses are allowed under section 57? For mutual funds, 20% of, you have hired some person to write the, you are giving salary to him, he will handle all your investments. Will that be covered? So I'll make it into two things. Interest expense, other expense. Interest expense, other expense. Similarly, administration, interest expense, other expense. How much will the interest expense be? How much is allowed? Is other expense allowed? I've already shown you. Let's see again. Section 57. Here you go. Section 57. In that, all these things, dividend, interest on securities, family pension, other expenditure, all this there you see, proviso. No deduction shall be allowed from the dividend income or income on respect of units of mutual fund 2023D or income from units of specified company 1035 other than deduction on account of interest expense. And in any previous year, such deduction shall not exceed 20% of the dividend income or income in respect of such units. So guys, income of, here also I'll write down, specified plus admin. It is exempt under 1035. Unit holders, definitely taxable. Now tell me guys, interest expense, how much? 20% of that interest income, 20% of income. So if I earn 1 lakh, 80,000 I should offer to tax, 20,000 is allowable deduction. Other expense not allowed. Interest expense 20% of income. Other expense not allowed. Oops, sorry. So they'll ask in the exam one question. They can ask units of administration, income earned is 1 lakh. Interest payable is 30,000. Other expenses are 20,000. How much is allowed? Option A, 30,000. Option B, 50,000, 30 plus 20. Option C, 20,000, 20%. Option D, none of these. Answer. What did I ask? Total income earned is 1 lakh. Interest on the loan that you have taken to earn this amount is from administration unit, from the children's scheme. Interest is how much? 30,000. Other expenses 20,000. They'll ask how much expenses allowed as a reduction under 57. MCQ question. First one 30K. Second one 50K. Third one 20K. Which 20K? Income into 20%. Fourth one, none of these. Answer. 99% of the students will tick 20,000 and come. Answer is 50K, my dear friends. How, sir? What are you telling? Please see. In 57, mutual fund unit is there. Specified company is there. Where is administrative company? Not there. Administrative company is not there. This is there. This is there. Administrative company is not there at all. So guys, good, got it? Fully allowed. Fully allowed. Important. As per proviso to section 57. All this is what? Proviso to section 57 only. Proviso to section 57. As far as taxes are concerned, that would be what? Same, TDS or capital gain as such. As far as TDS is concerned, 194K will come. Income more than 5,000, TDS at the rate of 10%. TDS at the rate of 10%. Capital gain depends if it's an equity oriented fund or it is other. If it is other fund, 112 will come, 20% tax. If it is an equity oriented fund, then we have to see whether it is short term or long term. 111A, 112A. So it would be 15%, here it would be 10%. If what? If it is two things. One, stock exchange where STT is paid. Second one, sold to another mutual fund where STT is paid. If STT is not paid, then normal provisions will come. This you have already seen, guys. I'm just repeating. So two things, stock exchange is there and STT is paid. Second one, sold to another mutual fund and STT is paid. Yes. So these two things will come. That's all there is to it. Nothing else. Chilled out. Same stuff is given here. Easy. Right? Done. Cool. So actually, guys, I thought I'll do ESOP in this only. No problem. Next session, I'll do ESOP. Okay? ESOP is immediately next session. ESOP and ESOP tax on startup. Both will do next session. Hi, guys. Let's finish off taxation of ESOP. Again, very important. So see, guys, you have income from house property and income from salary. That is also part of the syllabus. But then whatever was there in CA Inter, all that allowances, etc., and house property calculation, nothing they'll ask in the exam. What they'll ask is some higher level items. Higher level items like, for example, taxation of employee stock option plan, because this will come under section number 17, which is your perquisite chapter. So under perquisite chapter, particular thing will come. Similarly, taxation on the startups, etc., that will come. So they'll combine this. If you sell your ESOP or if you buy ESOP, what is the taxation for the company? If the person sells that ESOP, whatever he had, what is the taxation for the particular person? All those questions they'll ask, right? So that salary part comes there. If you remember in income from other sources, we had done clubbing provisions, basically not income provisions, clubbing provisions. You also did a concept called deemed donor. So it will come there. So deemed donor is section 27, which is obviously house property. So those higher elements of classes will come, higher elements of concepts will come in CA final. That basic, LOP, DLOP, all this will not come, guys. They have other things to test you and not those things. So do not worry about all those things. But nevertheless, if you want to brush through the normal salary chapter, HP chapter, I will also upload. You can check a little while later. I will upload an open PDF on higher this thing, house property and salary. You can go. That is, CA Inter stuff you can go through. But CA final student will not have the time to check all those things, because so much is here only to ask. So they will not ask those things. Generally, it has never come, but I will never say salary and HPD will never come. It will come in terms of this. For example, ESOP is nothing but salary chapter. It is salary chapter, capital gain chapter. Similarly, clubbing of income is a separate chapter along with deemed donor, which is house property. So that's what I am trying to tell. So let's understand the concept of ESOP. ESOPs are taxable as perquisites in the hands of the employees. Perquisite in the hands of the employee. So if you see section number 17, which talks about what is a perquisite. Let's see. (17)(2) perquisite. So in this, if you see here, the value of any specified security or sweat equity shares allotted or transferred directly or indirectly by the employer or former employer free of cost or at concessional rate to the SSE. So guys, what is this? Generally, let us say on 1/1/19, you are employed in the company, I work for a couple of years, let's say. So I will offer you 1,000 shares of ESOP. The fair market value of those shares are, let's say, 1,100 rupees. On 1/1/21, they will tell, I will offer you only if you work for 2 years. These 2 years are called as the vesting period. On 1/1/21, you now become eligible to buy the shares. You become eligible to buy the shares, which means vesting has happened, vesting period, eligibility. Here, fair market value, let's say, is 1,200. You will be given a vesting, period, a period where you can exercise the option. You can exercise the option. You will exercise the option, let's say, on 1/7/2021. 5-6 months will be given. You will do it on 1/7/21. Option is exercised. Now FMV is 1300 rupees. They will immediately not allot in the moment you exercise. They will allot it sometime later. Let's say a few months later, 30th November 21. Or let's say next year 22. They will allot. This time FMV will be at 1500. 1000 shares of ESOP, face value 10 rupees. Now guys, tell me, what does the law says? The law says that taxability will arise at the time of allotment. Taxability will be at the time of allotment, but the FMV will be the date when the option is exercised, because that day you decide to buy. Just because the company delays by so long, you cannot hold the person liable for that. So at this price, 1300. So 1300 will be the, FMV. Minus what? Face value. It's 10. So 1290. 1290. This will be the value of the perquisite, which is taxable in whose hands? Employee's hands. Right? It's an option given, so this will be taxable in the hands of the employees. So in the previous session, we did taxability and we did ESOP also. That ESOP was what? That was buyback of ESOP. So then obviously it is taxable in the hands of the company. This is not buyback. This is giving ESOP. So when I am giving ESOP, obviously it will be liable in whose hands? It will be liable in the hands of the, what do you say, shareholder. That is the employee. Now many tax planning they used to do. Since this is for an employee, they used to wait for the employment to get over. After that, one day later, they used to issue ESOP or similar something to ESOP or sweat equity. What is sweat equity? That is for the sweat that you have given to the company. So sweat equity is different. Sweat equity is for the consideration already paid. So if you have worked something, if you have given know-how, if you have obviously worked hard in the company, then that is ESOP. So one of my dad's friends, he joined Infosys, true story, in the year 1986. In the year 1986, just when Infosys was forming, at the formation only he started. 1982, Infosys came. So 1986 he joined. He worked for 14 years in the company, 1986 to 2000. He was the person to construct all these, civil engineering work. All campuses were under his guidance. In 2000, Narayan Murthy went to MCA and went to the ministry and said, I want to, there is a section in, Companies Act. True story this is. This is how this entire section came about. There was a section 53 which said, any share issued by a company at a discount shall be void. Narayan Murthy went to MCA and said, sir, I want to give free shares to my employees. MCA said, not possible, sir. He said, why the hell? He said, no, sir, not possible because this is section. He said, boss, employees have given their blood and sweat for the company. He named the term actually, sweat equity. They have given their blood to the company. You need to allow me to do that. Based on strong recommendations in the Companies Amendment Act 2000, same year, section 54. That was old law, 1956 law. A different section was there. Sweat equity shares was inserted. See, 79A was inserted. 79, 80 were there. 79A was inserted in 2000, 1956 Act. Right? Yes, you are notwithstanding anything contained in 53. What is 53? You cannot issue shares at a discount. Here it says, yes, may issue sweat equity shares if this procedure is followed. And you see section 53 also. There they have said, except as provided in 54, company shall not issue shares at a discount. Wonderful. So my dad's friend, Narayan Murthy called my dad's friend and he handed over a check for sweat equity shares. That time in the year 2000, 24, 25 years ago, 23 years ago, that was valued at, believe it or not, 2 crore rupees. 23 years ago, 2 crore. He said, sir, from tomorrow I'm quitting. He said, no problem. Your wish. Please go spend time with your family because 14 years you have given your life, your sweat, your blood to Infosys. Next day he quit. After that day, uncle has never worked. And recently he passed away after COVID. I mean, not due to COVID, but after the COVID phase, he passed away because of cancer. But he lived his life, was a very generous man. He did a lot of social service activities. If you get 2 crore worth of stuff and you invest properly 25 years ago, you just imagine how much that 2 crore would have fetched, right? Smart investment, nothing. It was a lot of money that time. Now also it's a lot of money, but think about it. So many years ago, it was a lot of money, right? So that is what it is. So what people used to scam, they used to do this. They used to tell boss, it will be tax. So the taxation also, all that came that time. So they used to do one scam. Bro, you resign today, okay? Tomorrow I'll give you. Why? Because employee stock option plan. I'll name some other thing and give it to you. Only when employer-employee relationship is there, I can give. But the employer-employee relationship is not there. So take it. Point number 1. Point number 2. Reliance Industries, or let's say Tata Consultancy Services, TCS, is giving ESOP to an employee. Rather than giving Tata's consultancy services shares, he will give Tata Motors car shares. And you cannot come until security is given. Some other company have given, not this. What is sweat equity? Only that company only if you give sweat equity. I'm giving some other security. Tax planning was happening. Finance Ministry did not like it. So obviously you see the perquisite here only. The value of any specified security, deadly. This was added. The value of any specified security. In 2009 Finance Act, they substituted it. Value of any, because 2000 to 2009 people played around like this. Any specified security, which can be anything, by the employer or former employer, was added. Nothing doing. So even if you get 1 year ago you were working in a company, today you get sweat equity for the work done that time, chargeable to tax. ESOP you are getting, chargeable to tax. Specified security means securities as per SCRA. That's all. Anything, guys. Equity shares, preference shares, units, everything is covered. Sweat equity means equity shares issued by a company to its employees at a discount or for consideration other than cash. You see, FMB of the specified security on which the option is exercised as reduced by the amount paid or recovered from him. If it's sweat equity, generally it is nil, or the face value. FMB means the value determined. Now this is what they give. FMB. This is all 17.2. So I told you here, no, FMB. I told you here FMB. How to compute? Summa I wrote 1300. How did I compute that? Now that is there in part as part of rule number 38. Computation of this FMB. Valuation of perquisite. This is purely salary chapter with the rules. So check it out. ESOPs are what? So if you see, one is the, is it a option given or is it mandatory? Employee stock option plan. If I had invested, I was working in a company in 2008 wherein the stock market, the entire subprime mortgage crisis. 2007, they had given me an offer for buying at 500 rupees. 2008 crisis happened. My company tanked. And in 2009, at the time of exercise, market value was 7 rupees. But the exercise price was 500 rupees. Can the company force me to buy the share? No. That's why it's an option. Employee stock option plan. So you see, perquisites are to be taxable in the hands of the employee in the year in which shares are allotted to him under ESOP. I told you allotment year. But perquisite shall be calculated on the basis of FMV of ESOP on the date when employee exercises his option. Taxable perquisite shall be determined as under FMV of the shares on the date on which option is exercised A, amount paid or recovered from the employee in respect of the share B, value of the perquisite taxable when shares are allotted A minus B. Very, very simple. Determination of FMB. This is what, generally you need to just go through. This chart is enough. Where shares in the company are listed on a single recognized stock exchange, FMB will be average of the opening and closing price of shares. Very simple. Opening, closing, average on the date, which date? Exercise of option. But on the date of the option, exercise of option, there was no trading. 15th August, there was no trading. Then closing price of the share on any recognized stock exchange on the date closest to the date of exercise of option. Previous day, immediately preceding such date. If 15th August was a Monday, 14th August was a Sunday, then, Saturdays, Fridays, like that you should see. Where shares in the company are listed on more than one recognized stock exchange, then average of opening and closing price of shares on the date of exercise of option on a recognized stock exchange which has the highest volume of trading. You should see the turnover for those particular shares in which stock exchange it is more. So that I should take average opening and closing. Similarly, if it's not there, previous day. Where shares in the company are not listed on a recognized stock exchange. For example, Google India shares are not listed. In those cases, value on a specified date will be as determined by a merchant banker. Chartered accountant is not there, merchant banker. It is the date of exercise of the option or any day earlier than the date of exercise of the option, not being that it is more than 1 day. So basically, guys, if 15th August is the exercise date, on that day you will see, or you will go back 6 months. Any day he will take. That purely depends on the merchant banker. There are a lot of other things he will do that. That valuation and all is not important for us. That's it. When the employee is selling shares, full value of consideration, sale value, less cost of acquisition will be the FMV of such shares. LTCG or STCG will come. What is the period of holding? Obviously, from the date of allotment will the period of holding start. From this day, it will start obviously. What is the cost of acquisition? Shall be the FMV which has been taken into account for the purpose of section. So for him it is 1300. This is what is taken into account. That is all. That's all I'll have to pay. This is how it is calculated. Right? Very, very simple. Now, there were a few things also. Like for example, if I give a tea box, Tata has, exported tea. So export quality tea. Nobody else will get. Only in the AGM they have declared that, okay, tea I'm giving. Tea box. Is it 222A distribution of assets? Is tea box, it's a raw material, it's a finished goods, it's an asset. So guys, no. Why? As per 222A it says, any distribution to all the shareholders. Now tell me, are they giving it to all shareholders? No. Not given to all shareholders. Not given to all shareholders. It's only given to those who actually come for the meeting. If you don't come, you'll not get tea box. And even if the person who's taking 1 share, even if the person who has 1 lakh share, he'll only get 1 tea box. What, for 1 lakh fellows, I'll get 1 lakh tea boxes? No. So since it is mentioned that, this is what we need to keep in mind. Very, very simple. And CBDT had also clarified that I told you, no, this one. This entry. Will you get allowance? No, disallowed as per CBDT. Remember, in ESOP, when I do accounting purpose, you cannot account like that. ESOP expenditure 90 lakh, bank account 10 lakh, to security, share capital 10 lakh, security premium, all that. It's ultimately book entry. Not allowed. Not allowed. This is the correct one. Right? So guys, this is one part of the story. This is one part of the story. What is the second part of the story? What is the second part of the story? Second part of the story is, think about it. You are a startup. Obviously, some Pani Puri shop and all cannot call it as a startup. There should be a proper startup. This startup, let's say, has around 10 employees, and they have given 50 lakh each, ESOP, 5 crore. What was the problem, guys? In a startup, no one cares about the salary. They all look for a stake. All the startups started like that only. What is my stake in the company? Because they have a vision. They know that the company will really do well. And going forward, when the company really does well, I cannot just work on some salary. So if you see an ICA's founder, after the startup became public, crazy money she made. Similarly, Zomato also, right? Only Paytm, fellow poor guy, it did not make so much money. Then Paytm went for buyback also, all that thing happened. Anyway, so basically 10 employees of 50 lakhs, 5 CR. If I do this ESOP 5 crore and you exercise the option, whatever, first of all, guys, is there TDS on this ESOP, etc.? Yes, TDS outflow, since it's a perquisite. From the company's point of view, TDS will go. From employee's point of view, let's say exercises the option. His salary will be some, let's say, 3 lakhs per month. He exercised the option for 50 lakhs suddenly. What to do, guys? How will he pay? So that's why they requested the government that, sir, for ESOP, please do something. For ESOP, kindly defer the taxation. Kindly defer at a later stage taxation. So how will you defer? If my salary is, let's say, 15 lakh, ESOP is, let's say, 50 lakh. Now, as I told you, overall 65 lakh. Sir, I will pay tax on 15 lakh at the highest rate, 30%. 19.5 lakh I'll pay. No problem. But, sir, the tax on this 50, sorry, tax on overall 65 lakh. Tax on overall 65 lakh is how much? 19.5 lakh it will come. This one, sir, especially 15 lakh you leave, sir, but this part, that 50 lakh extra, kindly defer it. How to defer? One is 140 subsection A, self-assessment tax. So tax on this 50 lakhs is, tax on 50 lakh is 15 lakhs. Overall tax is 19.5. Sir, I will pay 4.5 lakh. Remaining thing, please defer to a later date. What is the later date? We'll see. Second, under section 156, if you do not pay the tax on time, there will be a demand notice in any of the intimations. They amended that law saying that there will be no demand until that date. Which date we will see. Third, in TDS 192 1C was inserted. 192 1C was inserted. Now they say company no need to deduct TDS. You will deduct later when he exercises the option or when he leaves, whatever. We'll see at the later date you do. Immediately only don't do. Then under 191, it's a direct payment. Which means if TDS is not deducted by employer, employee has to pay. This also got amended. Even if the company does not do TDS, deduct TDS, you have to deduct TDS at a later date. What is that later date? We'll see. All these things were amended to a future date. What is that future date? We'll see. See the notes. Page 12.2. You see, as per section 17(2)(6), perquisites includes the value of ESOP allotted or transferred by an employer to the employee. Accordingly, value of such perquisite is taxable in the year when such ESOPs are allotted or transferred to the SSE employee. This leads to cash flow problems for the employee who does not sell the shares immediately and continues to hold the same for long term. Startups generally use ESOP to attract and retain highly talented employees as the startup has liquidity crunch. To incentivize the startup ecosystem, Finance Act 2020 has deferred the tax liability of the startup employer 192 1C and also the tax liability of the employee 140A. Within, this is important, 14 days from the specified date. 14 days from the specified date. What is specified date? Expiry of 48 months or 4 years. That is from the end of the relevant assessment year. That is year in which the ESOPs are allotted or transferred. Allotted or transferred. So for example, if it was allotted on 30th March 2022, what is the relevant assessment year? 23-24. From the end of 22-23. The end of 23, 4 years. So guys, apart from 48 months, I will get this 12 months also. So roughly I'll get 60 months. So basically, actually I'll get 5 years. Assessment year is 1 year plus 4 years. 5 years, deferred by 5 years. Because that is the time when I'll know whether the company will really do well or go down. In ESOP valuation, everything will go for a toss anyway at the time of exercising. Or whichever is the earliest, obviously. Or ESOPs are allotted or transferred. This is vesting period if it's so long. What if it's allotted now only? Or if it is sold, then obviously you have to pay. No, you cannot transfer the ESOP to the shareholder and then he will coolly wait. No. 14 days from the day ESOPs are allotted or transferred. Third, date of sale of such ESOPs by the employee. Generally there will be a, time period. By this you should not sell. If you sells before that, yes. Date on which the SSE ceases to be an employee, yes, I will leave my job. If I leave, yes, that date, whichever is earliest. Note 1, the employer shall be eligible startup in accordance with ATIAC. We have seen this that time. There is no change in the value of perquisite in the year of chargeability. That's the perquisite continues to be chargeable in the year of accrual allotment. Only payment of tax is deferred. Chargeability will continue, payment is deferred, that's all. The effects are as under. Value of perquisite on ESOP shall be included in the income of the employee in the previous year in which the ESOP is allotted. If ESOP is allotted in 28-1-23, perquisite on ESOP shall be included in the income of the employee previous year 22-23, that is assessment year 22-23. However, as per the amendment in section 140A, self-assessment tax shall be reduced by the tax on perquisite, besides other reduction. Therefore, employee is not required to pay tax along with the return and he shall not be treated as assessee in default. Though he has to offer to tax that year, the payment will be deferred. The employer shall deduct TDS on ESOP within 14 days from the specified date, as per the newly inserted section. As per 192(1)(c) Inserted Finance Act, if employer is not able to deduct tax within 14 days, employee shall pay the tax on his own within 14 days from the specified days. This was 191, direct tax scheme. As per 156(1), AO shall issue a notice of demand specifying the sum payable on which value of purchase are disclosed in ROI for the year in which ESOPs are allotted or transferred. Such sum would have generally been payable within 30 days. And SSC would have been read as SSC in default. That's why one more clause was inserted in 156(2). A protection to SSC. The employee shall not be deemed as SSC in default on receipt of notice in demand. However, provisions of deeming the employee SSC in default shall become applicable only if you do not make it within 14 days from the specified date. 14 days from the specified date. 14 days of what? Specified date. So let's solve a problem, guys, so that it will be very easy for you. It is there in my compiler also, separate questions, but you solve this now. We'll write it together and solve. Mr. Ambi was an employee of Master Limited, eligible startup, gross salary 26,50,000, December 2019, granted options to apply for 20,000 shares at 20 each. All options were exercised. By Mr. Ambi on 1st March 2020. FMB was 200 each. So guys, exercise FMB only you should take. So this is an important FMB. Shares were allotted. This becomes cost of acquisition, remember. Shares were allotted on 20th July 2020 when the FMB was 230 per share. This is irrelevant, but this date is important for period of holding. Now out of this 20,000 shares, $10,000 shares were sold through recognized stock exchange on 5th August 2023 at 500 rupees each. Second, 10,000 shares were sold on recognized stock exchange, 700 rupees on May 15th, 2027. He resigns from the post on 31st March 2028. What are the tax consequences? What are the tax consequences? So check it out. First of all, what is the gross salary? 26,50,000. Value of perquisites, how much? 20,000 shares is getting. What is the FMV, guys? What valuation? You have to do 200 rupees minus this one. That is the perquisite face value. That is what they are allotting him, right? 200 is giving at 20 rupees. This is the value of perquisite, 36 lakhs. So, less standard deduction. See, this is an income from salary question, 50K. Overall is how much? 62 lakh. Tax on this entire thing. Normal provisions, if you do tax, 19 lakh, 13,340 will come. Overall tax, this will come. So I need to figure out what part of it is to be deferred. See, I told you that time 30%, thinking everything is over above slab rate. Here I have to take the slab rate also. Now I have to compute average rate of tax. Average rate of tax. How much is it? 19 lakh 13,340 divided by 62 lakh into 100. 30.86%. So tax to be deferred under section 192(1)(c). 30.86% of 36 lakh. 11 lakh 10,960 is to be deferred. Average tax I should calculate. Actual calculation is like this. So what is the tax to be deducted? As per 192, it is 8,02,380 rupees. So assuming the company deducts all this, his direct is advance tax, etc. properly, self-assessment tax will be nil. I mean, TDS only if they deduct, advance tax also will not come, self-assessment tax also will not come, nil. Now, 10,000 shares sold on 5th August 2023. Now, as per the section 192(1)(c), TDS liability will come earliest of the three. First one, when was the thing given? Year, this one. So what is the financial year? 31st March 21. What is the assessment year? 31st March 22. This comes under the assessment year 21-22. Simple. It comes under the assessment year 21-22. So assessment year 21-22 plus 48 months plus 14 days. That is 31st March 22 plus 48 months plus 14 days. 23, 24, 25, 26. 31st March 26 plus 14. So April 14th, 2026. Point number 1. Point number 2. 14 days from the day he exercises the offer. Sorry, 14 days from the day he sells or makes the transfer. That is which day? Talking about 5th August, you know. August plus 14 days, 5th August 23. 19th August 2023. Third one, 14 days from the day he leaves the job. When does he leave the job? 31/3/28. 31/3/28 plus 14 days. 14th April 2028. So what is earliest of the three? August 2023. So on 19th August, this only no, 19th August 2023 will be taken into account. So on 19th August, you have to obviously deduct TDS proportionately. What was the entire amount to be deducted, guys? Tax to be deferred 1110,960. 1110,960 was actually for 20,000 shares. So it should be divided 10,000 shares out of 20,000 shares is being sold. So 5,55,480 has to be deducted. If this is not deducted, deemed to be in default. Deemed to be in default. Capital gains will be what? Sale proceeds. Sold it for what amount? 500 rupees, right? 500 rupees. 500 rupees into 10,000, 50 lakh. Cost of acquisition. As I told you, 10,000 shares into FMV as on the date of exercising the option, 200 rupees, 20 lakh. Long-term capital gain, 30 lakh. Tax on capital gain you can compute. Remaining, when should he, one is this 19th August. Next, that is done, 19th August 23. Then what should he do? The balance 10,000 which he has, that should be done same. If you see 15/5/27, that is the day he gives plus 14 days, or resigns. Come back. 14th April 28 or 14th April 26. Correct? 19th August is when he sold. You leave that. Next time when he sold, 27. So 14 days, the 27, that will not come. 14th April 28 will not come. What will come? 14th April 26. So on 14th April 26, company has to deduct the remaining 5,55,480. Otherwise gone. Otherwise gone. That's it. When you sell it, whenever it is, when you sell, how much did you sell it for? 700 rupees, 70 lakh. Minus what is the cost? 10,000 into 200, 20 lakh, 50 lakh. Capital gain on May, capital gain in May 2027 will be 70 lakh because 10,000 into 70 minus cost of acquisition is 10,000 into 200, 20 lakh, 50 lakh. That is separate. This is how we need to see. If at all they ask the question, it will come like this. This was an examination question. That's all about taxation on ESOP and startup taxation. So in the next class, we'll start off with very important concept of trusts. Trusts. Charitable trust, religious trust, next class. Take care, guys. Hello, my dear buddies. How are you doing? So guys, lecture number 87 today, and we shall start off with a very interesting topic, very important topic, very easy topic called MAT. So generally, guys, in this question, they will definitely ask a question in the examination, very important. People generally have this notion that MAT is very difficult, etc. It's not like that. It's just that if you understand the logic and the concept of everything, no, it becomes very simple. So guys, just think about it. If my, as per Companies Act, right? As per Companies Act, I will obviously calculate something called as the book profit. So as per Companies Act, I will calculate the book profit. But as per Income Tax Act, I will somehow make the taxation nil. By the way, the MAT topic in our notes is in page S.1, S.1, S.2, like that it goes. Please see module number 1, minimum alternate tax, MAT. 115 JB, that's how it is. So tax rate, generally they'll make it nil. How I'll make it nil? One, by claiming the depreciation, you have additional depreciation, etc. Then we have a lot of exemptions, section 10 exemptions, and then of course we have ATIA, ITIB, all these deductions, etc. Exemption deductions, ATC deductions, all your 80 series, 10 series, 10 AA series, whatever the case may be. So because of which many companies were claiming the book profit to be high, and of course the tax profit when you compute using the income tax laws, they used to make it almost nil. And the master manipulator, or more than manipulator, I would say, when manipulator is a wrong word, but what I would say is the master income tax planner, where there was a thin line of difference between tax planning and tax saving, tax avoidance, so to speak. Tax avoidance and tax planning is a very thin line of difference. Tax evasion is totally where you don't even offer your money to tax. That's a different thing. I'm not talking about tax evasion, but I'm talking about tax avoidance and tax planning. The master of tax evasion and tax planning, tax avoidance and tax planning, was none other than Dhirubhai Ambani. Because of Dhirubhai Ambani, so many laws have changed, guys, actually. In fact, because at his behest, many laws were also changed in his favor. I usually tell it in, our company law. He changed a section called intercorporate loans. There was a section called 372 capital A in the old Companies Act that he changed because he wanted the DuPont deal. So all that I discuss in Companies Act anyway. So here also many changes he did. Master tax planner, so to speak. So there was this, generally there was this minister called VP Singh. Used to be a minister. He was a finance minister in 1986. So 90% of the changes he made during the 1986 budget, of course we were not born, but then if you just read the history, you'll know that he did it only for what? To ensure that Dhirubhai Ambani it's against Dhirubhai Ambani. Basically, he had a huge problem, public tiff with Dhirubhai Ambani. To just do a simple Google search, VP Singh and Dhirubhai Ambani, or VP Singh versus Dhirubhai Ambani, you will see the full history as to what happened, why they were always fighting, all those things. So he introduced actually a concept called minimum alternate tax. Imagine, VP Singh way back in 1986. He said, Companies Act, you are showing super profit. Here you are showing 5,000 crore profit. Here you are showing nil. I'm missing out on this. So he said, you should pay tax on either of the two. Either this, if this is nil, or here you should pay. So introduced in 1986, and Dhirubhai Ambani coolly ensured that he will not pay 1 rupee also even under the new regime of MAT because of his tax planning techniques. Then in 1987, superb amendments VP Singh made, still Dhirubhai Ambani won. In 1988, still Dhirubhai Ambani won. And in 1989, VP Singh also was thrown out. MAT also was abolished. MAT also was abolished. Right? So it was in the year, if I'm not wrong, 1997, when Lungi Man, Chidu, was the guy who said that Ambani has been defeating tax, etc. So actually Dhirubhai Ambani passed away in the year 2022. This was his last final years. He said, I will draft in such a way that nobody can change it. Chidambaram is a very smart guy, guys. He is a, lawyer who was also practicing. Of course, he was, honorary professor of Harvard and Oxford as well. So when this fellow said, Lungi Man, that I'm going to change the way things are done here, people thought, okay, nobody can touch him. Dhirubhai Ambani took it up as a challenge. And during his last few years of his life, still Dhirubhai Ambani won. Though whatever Chidambaram made all changes, he himself has drafted the law. So MAT has himself been drafted by the man himself, P. Chidambaram, right? So this is the concept of MAT, guys. Minimum alternate tax. Minimum alternate tax. So we'll dive into it. Basically, it starts with 115 JB. Now still MAT is very much applicable, and Dhirubhai Ambani has still, managed in 1997 only to change it. It went up to the Supreme Court. Supreme Court also agreed nothing can be done. So Ambani, won that particular, entire tax planning thing. That still can be done, but only in big companies. I'll tell you all those things, what happened and all that. Don't worry. Right? So on that note, let us now dive into, what do you say, minimum alternate tax concept. Let's come to the notes. See, applicability, guys, it is for all companies SSE, all company SSEs. On companies only have to pay. Objective, as I told you, to ensure, to ensure collection of minimum amount of tax from companies which have book profits but very less taxable income. Provisions of Section 115 JB have been enacted to restrict availability of certain exemptions, incentives and deductions to companies so as to collect minimum amount of tax at least. So two parallel computations have to be made, my dear friends. Two parallel computations. One is income tax as per normal income tax provisions. Second one, 115% of book profits. So they are trying to tell, bro, you pay this one, okay. Or if this is not even there, at least you pay 15% of book profits. At least you pay 15% of book profits. So 15% of book profits will be the tax. So either, guys, A or B, whichever is higher. A is as per the income tax provisions normal. Along with that, you should what? Add surcharge. And what is a surcharge? You know that this is the surcharge in case of, MAT provisions. 1 crore to less than 10 crore, domestic company 7%, foreign company 2%. Income more than 10 crore, domestic company 12%, foreign company 5%. And of course, after that, health and education cess. But there's a small relaxation for what? IFSC, International Financial Services Center, which derives its income solely in convertible foreign exchange. MAT is chargeable instead of 15%, it is 9%. It is 9%. So guys, 115 JB, applicability provisions, etc. So important, of course. So this particular company, section, will not apply to certain companies, will apply to certain companies, and all that we need to understand. So basically, right, we need to see where it applies, where it doesn't apply, and other things, so as to understand the entire scheme of things. Now, if you see, let us see, 115 JB is the MAT provisions. We'll take you to the Bare Act. See, notwithstanding anything in the any other provision of the Act, there was an income tax Supreme Court case law which said notwithstanding anything contained means it overrides the entire income tax law. Wrong. Notwithstanding anything contained in any other provisions means it overrides only the conflicting provisions of law. Which means, will penalty apply? Yes. Will advance tax 234 ABC apply? Yes. Right? Only the conflicting provisions will not apply. What? Normal tax provisions will not apply. This will apply. Then there are some additions, deletions we'll have to see. Where in the case of an SSE being a company, will it apply to foreign company, domestic company, all companies? 100% it will apply to all companies, guys, because it uses the word a. It uses the word a. Being the income tax payable on the tax as computed so and so in the same year is less than 18.5% of its book profit. Now this one, 18%, it became 18.5%. And that, if you see, from April 1st, 2020. So as of now, guys, it is 15%. So here in our notes, you have written, no, whatever this is, it was 18.5, now it is 15 is correct. I have reduced it. So a company will include foreign company also, basically every company, guys. As of now, a company, all companies are included is what you need to see. And of course, I told you already the, what do you say, tax on total income, how much will be. Then book profits also you need to see, whichever is, higher is what you need to understand. Very simple. So one book profit is so much amount. To that you add surcharge and secondary cess. Similarly, with tax normal also, you do the same thing. Then whichever is higher is what you need to see. So A or B, whichever is higher. For everything, you have to add surcharge because surcharge cess will be the same anyway. Compare the two and see whichever is higher. Very, very simple. Now, here, 115 JB2 here. Every SEC being a company which has prepared what? As per clause B. One second, I'll just show this. So this part, I'll again explain what happened. Again, Ambani guys, Dhirubhai Ambani, smart guy. So Dhirubhai Ambani, what did he do? First part, before JB, 115 JB was inserted, okay, no tension. But in this, what happened? I prepared two balance sheets. One, Companies Act to be given to the shareholders. Generally, guys, how it works is, just for your understanding, Companies Act provisions, the accounts will be prepared by the management. This is books of accounts. I'm talking about Companies Act. And the financial statements will be prepared under section 129. Right? And then these financial statements will be approved by the board of directors, right? And they will authenticate. Authenticate means what? They will sign. After signing, it will be sent for the auditor report. Sent to auditor. Then board will give the board report. After seeing the auditor's report, board also will give the board report. After that, under section 136, all these documents, that is financial statements, notes to accounts, then auditor's report, board's report, under section 136 will be circulated to all shareholders. Circulated to all shareholders. And once it is circulated, under 102 of that AGM will happen, where they will consider the accounts. After considering the accounts, they will adopt the accounts. After adopting the accounts, they will file the entire thing. Your annual accounts will be filed under that, section 137. 137, they will file in AOC 4. Annual return also will be filed under MGT 7. This is the entire scheme of things. Now, where we will come in here, if you see, for this, for laying before the AGM in front of the shareholders, because I want them to adopt the balance sheet P&L, what will I do? Companies Act, under Companies Act, I will prepare a different balance sheet where depreciation I will show 10k crore and net profit I will show 201 crore. Then for tax purposes, I can increase the rate because depreciation as per Companies Act is the bare minimum that they have given. So here I can increase the rate to, okay, here let me make it 20k. Net profit is 20k crore, depreciation is 10k crore. Here depreciation I can make it 30k crore and this I can make it nil. So one balance sheet for the Companies Act and one balance sheet Companies Act purposes, from the Companies Act purposes for tax purposes. Where I'll say, sir, this is for the Companies Act, laying before the shareholders. One more is, for the tax purposes, I have computed higher rate. Who are you to tell? This issue went to court in many cases. Court said, nowhere it has been written that for income tax purposes, I cannot make a separate, balance sheet and P&L. So the government lost the case. After they lost the case is one part of the story. Second part of the story, for example, electricity company, insurance company, banking company, you would have done in CA Inter Group 2. Electricity company, insurance company, banking company, these companies will tell that, bro, I have not, what do you say? Companies Act will not apply to me only. So you are telling book profit. Book profit means book profit as per Companies Act. Companies Act will not apply because I will prepare the books based on Electricity Act, Insurance Act, what to do. So these two were the dilemma. One was normal companies which are giving two accounts. One more is electricity company, etc. So will it apply or not is the question. So Chidambaram again inserted 115 JB2 saying that, okay bro, you got me. I understand. You please prepare two. I am also telling please prepare two balance sheet P&L. No problem. One for income tax, one for this thing. But accounting policy must be same. Accounting policy means what? Accounting principle and the method of applying that principle. Accounting principle is depreciation. Method of applying the principle, WDV, SLM, whatever you're doing. Rates, everything should be same. Right? Accounting standards used for preparing such things must be same. Accounting standards for one this separate accounting standard there, no. Methods and rates must be same. So basically, Lungi man created a level playing field saying that you prepare whatever you want, but the policies, etc., base should be same. Then I will accept. Then for insurance company, banking company, okay, book profit for you may not be Companies Act purposes, so book profit for you will be your own act purposes, which means prepare the balance sheet and P&L as per Electricity Act, Insurance Act and Banking Act. In that only I will charge, no problem. I will charge as per that only. MAT. MAT is tax on normal provisions or 15% on those provisions, whichever on the book profit, whichever is higher. Book profit I will deem it to be banking only, no problem. Right? No problem. Like company would have amortized the expenditure on voluntary retirement scheme over 5 years in the what do you say, Companies Act balance sheet P&L to be shown to the shareholders. But for tax purposes, that full amount they would have done it that year only. There is no hard and fast rule. Policy would be different. No, policy would be different. In one case, they would have used like the old AS11. The other case, they would not have used that. Policy would be different. Policy. Higher rates I would have chosen for income tax purposes as per Companies Act only, because Companies Act gives the useful life, etc. But you can increase or decrease in I mean before 2013 you could have in 2013 2015 also they would have increased and decreased and all the number of rates of the depreciation rates if you have taken a proper, what do you say, written representation from management, also experts opinion. You have taken a valuer's opinion about increasing the useful life, you could have done that. All these golmaal people were doing. So now level playing field as per 115 JB2. Okay, you do two accounts, bro. No problem. One for income tax purposes, one for companies. No problem, bro. But bro, maintain the accounting policy, maintain the method of accounting, maintain the accounting standards, then no problem. Second part. You electricity company, insurance company fellows, do it. I'll do it as per your books only. I'm not going to change, right? Check it out. Same. In accordance with provisions of Schedule 3, you follow as per Schedule 3. And for other companies who are following under second proviso of 129 is nothing but banking company, insurance company, etc. You please do it as per the act governing such company, no problem. By Banking Act, Insurance Act, you do, no problem. And when preparing the annual accounts, ensure that the accounting policies are the same, accounting standards are the same, methods and rules, rates used are the same, no problem. Big deal. Shall correspond to all those things. So if you see, come here. Here. That is one part of the story. Then these are all additions, deletions, etc. Then you see this also. Provisions of the section shall not be applicable and shall be deemed never to be applicable for what? SSC is a resident of the country or a specified territory. Remember international taxation? Specified territory. That is your Hong Kong, Macau, etc. With which India has an agreement under 1990. If DTA comes, then provisions of the section will not apply. Right? And there may be some countries which doesn't even require any registration under Companies Act. So it's a completely foreign country, foreign company does not require any registration under Companies Act. If Tesla, a foreign company, opens a showroom or rather, branch in India, that Indian company requires registration. But Tesla, for that matter, doesn't require any registration as such. So both combined, check this out. Yes. Section 115 JB MAT shall not apply to foreign company when foreign company is a resident of a country with which India has entered into an agreement under 91 or 90A and which does not have a permanent establishment in India. So my Tesla example was 100% wrong. Why? Tesla Incorporated has a permanent establishment in India. Alibaba does not have a permanent establishment in India. So if Alibaba company, foreign company, resident of a country, China, in which India has an agreement, DTA, then the provisions of MAT will not apply to them because it do not have a permanent establishment, whereas Tesla has a PE in India through a subsidiary company. Foreign company is a resident of a country with which India has not entered into any agreement and is not required to seek any registration under any law relating to companies in India. Not required. Random company not required to have any deal with India. Open any company in its name in India. A foreign company has a permanent business in India, but its total income comprises solely, most important. Under what? 44B, shipping. 44BB, mineral oil. BBA, aircraft. BBB, civil construction, etc. Guys, solely. This company has shipping business plus income from other sources. MAT will apply. Important MCQ. One shipping business company also has other business, side business. It will apply. Shipping business, shipping companies got under 115 VO. Life insurance companies, separate act of parliament. Domestic companies which opt for, this one, see. Special rate of tax under 115 BAA, BAB. If you opt for special rate of taxation under 115 BAA, BAB, then domestic companies MAT will not apply. Similarly, Section 8 companies is for not for profit. Section 8 companies of Companies Act is a company which was not for profit. That's why for them also this section will not apply because it's principle of mutuality. Every company shall prepare the statement in Schedule 3. If you cannot follow, then follow the respective law, it says. Then as I told you, accounting policy, standards, methods, everything shall be the same. This requirement will apply even if a company adopts a year which is different from the previous year under the Income Tax Act. Income Tax Act is April to March. Even if you follow January to December, which is possible in some cases in Companies Act, here also you can do the needful. The following items shall be added back to the profits. These are the adjustments. Anyway, ICDS will not have any impact on computation of profit. ICDS will not have any major impact as such. So one by one, we need to do this, guys. These adjustments are very, very important. So basically, you need to add back from whatever the profit that you get, net profit. From that, you need to add certain items, subtract certain items to arrive at the book profit. Right? And the net profit, whatever you have already derived, add the following items. So whatever the net profit means, as per books, whatever you have made some adjustments. Add certain things, subtract certain things. And once you add and subtract, final thing will come. Based on this only questions will come. What should be added, what should be subtracted, etc. So our entire discussion, my dear friends, will be based on what will be added, what will be subtracted, like that. So let's see all the additions, my dear friends. So here, all these are additions and deletions, or additions and subtractions, so to speak. First one. See, so many are there. One by one you have to see. For the purpose of the section, the section 115 JB, book profit means the profit as shown in the statement of P&L for the relevant previous year as increased by, means like this is like a disallowance. This is like a disallowance as increased by. First one, amount of income tax paid or payable and the provision thereof. Paid and payable and the provision thereof. Right? And they have added an explanation later. 2008. 2001, this, 1997, this was introduced by Chidambaram. He drafted it. Again, people were scamming. I'll tell you this. Explanation 2. We'll see one part. All these things we need to check coolly, no problem. If any amount referred to in clauses 8 to I is debited to the statement of P&L account, then I have to add back. Please remember, I'll write down here, any amount debited to A to I should be added back, or any amount referred to in clause J which is not credited should be added back. I'll tell you everything, guys, don't worry. I repeat, I'll write down here. Items A to K, if debited to P&L account, to be added back. Then item number J, clause J, which is not credited to P&L account, should be added back. Which is not credited to P&L account to be added back. And any item which is credited to P&L account, this should be reduced. These are all items credited to P&L account. Right? This is from item number, you see, 1, 2, 2A, 2B, 2, 3, 2C, like that it will go, 4 to 5, like that till 7. 1 to 7, 1 to 8. 7, 8, 1 to 8. Then 1 to 8 items, they are already credited to P&L account. That has to be reduced. So in today's class, we'll have to discuss all these three, guys. A to K, if debited in the P&L account, add back. J, if it is not credited to P&L account, add back. I to 1 to 7, 1 to 8, credited to P&L account, has to be reduced. Coolly, one by one, we'll go. No tension, okay? Guys, as I told you, previous classes where there was no need for me to go slow, I have gone fast. International taxation, first few classes, out of 13 classes, first 10 classes were extremely in-depth. Last 3 classes were time pass. There is a reason for all of that. If you sit and study in-depth everything, then you will not remember everything. So we have to balance it out. MAT is important, right? And we cannot just, this is the add, subtract. No mugging up at all. It should be coolly, we have to study what all is there with understanding everything. So as you know, in our entire sessions, we have done wherever in-depth is needed, we have gone crazily in-depth. Wherever it's not needed, we have done normally. Wherever full time pass, fast, we have gone. So this is the balanced way to study. Otherwise, you will have so many subjects to study. How will you study, guys? Think about it, right? Let's see one by one coolly, okay? So guys, I repeat, it should always be debited. If it is debited, then it should be added back, right? Which means if it is debited in the P&L account shown as an expense, the government didn't want the expense to continue, so I'm adding it back. One by one we'll see. A. Then I'll show where is in the notes. This we are doing Where Act analysis. Come on, one by one. A. Amount of income tax paid or payable and the provision thereof. Amount of income tax paid or payable and the provision thereof. So, first is income tax. So basically, income tax payable, even in the normal income tax provisions, I will add back, or the provision thereof. For example, provision for tax is 60 crore. Net profit 100 crore. Correct provision, later they'll give in the exam, correct provision is 80 crore. You will add back 60 crore or 80 crore. Guys, as we have seen already, whatever has been debited. What is debited? 60 crore. So please add back 60 crore and not 80 crore. MCQ or questions adjustment, this will come like this. Second part of the story is interest on income tax. Interest on income tax, what should I add or not add? Whatever interest I've paid on income tax, 234 ABC and all those things, generally it is, the income tax, it is either, even if I debit it, basically it is penal in nature. So what many courts, one Supreme Court decision, it said that interest on income tax not to be added. This was not liked by the government, so this Supreme Court decision was nullified by insertion of explanation 2. There. For the purpose of clause A of explanation 1, the amount of income tax shall include any tax on distributed profits under 1150 and distributed under 115 are interest charge under this act, surcharge, education cess, secondary assess, everything to be added back. When I say income tax includes your dividend distribution tax, domestic companies, interest charge, 234 ABC, surcharge, education cess, secondary higher education cess, everything to be added back, my dear friends. No mercy. Everything to be added back. So if you see, point number 1, I've added it, everything here only makes easy. Interest, surcharge, education cess, everything. We'll see the examples here. So if you see, come to page S6. Income tax and interest disallowed under normal provisions, here also added back. It's like disallowing only. Penalty, both cases, when here it's disallowed, here penalty, guys, it is allowed, not to be added back. Did you see anything called penalty there? No, only interest. 234E fees, here it is disallowed, here not to be added back. These are important areas. GST, allowed subject to 43B, here also not to be added back. Other things we'll see. Right? Interest payable under any other act shall not be added back while computing the profits. Guys, income tax includes interest paid under the act. So I would say this is again an MCQ question. Interest under other act not added back while computing the book profits, which means they are allowed. They are allowed. Similarly, security transaction tax also allowed. Commodities transaction tax also allowed. All these are allowed, no problem. Next B. Amount carried to any reserve by whatever name called, other than reserved for shipping business. Apart from shipping business, any amount carried to any reserves by whatever name called also should be added back. That also should be added back. If you see here, transfer to reserves. But before that, what about provision for deferred tax? Under normal income tax provisions, it will be disallowed. Under MAT, Supreme Court said not to be added. Government did not like it. It was also nullified. Years later, if you credit it back, provision for deferred tax, if you credit it back a couple of years later, saying that this provision, I'm going to bring it back into books here, this also has to be subtracted. Yeah. Point number H. Amount of, this was again to nullify the decision. In 2008, they made it. Amount of deferred tax and provision therefore. H. So since it's linked to, tax, I'm just making it that here also is here. In our notes, you can mark this. Sorry. Deferred tax and provision for deferred tax. Similarly, later, if some other day they will add back, they will credit the deferred tax, then also I have to subtract it, obviously, here. If credited to P&L account, I have to reduce it. Very simple. Got it, guys? Second one now. Transfer to reserve by whatever name called. Transfer to reserve by whatever name called. Transfer to reserve by whatever name called. So if the net profit carried forward is 100 crore, net profit brought down is 100 crore, general reserve is 15 crore, net profit after that is 85 crore. I should add back 15 to 85 obviously and not 100. Goes without saying. Correct? It should be added like that. It is any transfer, even if it is a transfer as per the directions of the RBI also, it has to be added back. Any reserve, it has to be added back. Any reserve, transfer to general reserve, transfer as per RBI direction, even reserve created under 10AA, everything to be added back. No mercy. Transfer to reserves by whatever name called. We'll see these examples later. See here. It is allowed subject to 36(1)(8) here added back. Any type of reserve, please add back. Normal reserve, please add back. I'm doing page S7. Next, point number C. Provision for unascertained contingent liabilities. Here you see dialogue how it is. Amount or amount set aside for provisions made for meeting liabilities other than ascertained, basically for unascertained liabilities. Unascertained liabilities. So, if you make provision for salary, for example, March month, I will make provision for salary, March month salary. As per MAT, what to do, and as per Income Tax Act, what to do. Guys, since it is an ascertained liability, both it will be allowed, not added back. If I make an ad hoc gratuity provisions, so here it is disallowed, means added back. But if it is as per actuarial valuation, which means it is ascertained, actuarial valuation, add back, ascertained. I'm sorry, here you will not add. Why? What is to be added back? Only unascertained. Here there is no addition. As per Income Tax Act, you will add back, obviously, because it's an actuarial valuation, gratuity valuation. Provision for leave encashment. Assume it is scientific in nature. Scientific in nature. Not added. But here it should be added. And it's allowed to some extent. I can say 43B, allowed under 43B. I'll give you a list later. Any warranty, if there's any warranty as such, any warranty, there was this Rotork Controls Supreme Court decision, and for this ad hoc, provision for leave encashment, we had Bharat Earth Movers case law. These are all case law decisions. No need to remember the name. Rotork Controls India. Rotork Controls said both not to be taken into account. They are all unascertained liabilities, which means it has to be added back. Anyway, I'll give you just, I wrote down here. Here I've given, check it out. Here. Note number 1, you see. Here. Provisions made as per a scientific basis or actuarial valuation shall not be added back while calculating book profits. Why? Because they are scientifically generated. Correct. So provision for warranty, contingency, loss are all unascertained. But provision for warranty, if it is scientific basis, then it is allowed. That is what Rotok said. So just keep in your mind, anything which is scientific in nature will not be added back while computing MAT. But whether scientific or not, generally it will be disallowed under Income Tax Act. Some cases it will be allowed as per 43B. 43B already discussed. This is what you need to keep in your mind. That's all. Any ad hoc stuff, add back. Scientific stuff, don't add back as far as MAT is concerned. Got it, guys? All right, buddies. So we were discussing the provisions, right? So as I told you, anything which is ascertainable, it is okay. Unascertainable only, it should be added as discussed. Now, one more litigation happened. This was in HCL ComNet system. Whatever I am writing, no need of remembering the name and all those things, no problem. This was a Supreme Court judgment in 2008, whereby there was a provision for bad debts. Right? It was obviously disallowed under 36(1)(7), disallowed. But in the book profit, provision for bad debts is allowed because it was not an unascertained liability. Where is the liability for provision for bad debt? Supreme Court said it is not an unascertained liability. Then, is it a transfer to reserve? It was not a transfer to reserve also. So they said it should not be added back. Similarly, if there is any diminution in the value of assets with respect to other things as well, AS 13, AS 28, diminution in the value of assets, any value of any investment as such. So that also obviously should be added back as per income tax provisions, but it is neither an unascertained liability nor is it a reserve. So this was not added as per MAT. Created crazy litigation, but eventually the SSC won, especially in HCL ComNet system. To nullify that particular provision, there you go. Provision for diminution in the value of any asset was added. Right? So if you see here, the amount set aside as provision for diminution in the value of any asset. The value of any asset that was added. So if you see, any asset will include debtors also, no? So if you see note number 4. See, provision for diminution in the value of any asset includes provision for bad debts, provision for non-performing asset. Right, that is the next point, guys. So that is the scene. So I'm just seeing from a particular standpoint, we are checking it. Yeah. Next, other 2 points are simple. This holding companies, no. Subsidiary companies, if they show their losses, that's okay. But holding companies, since they hold 100%, 50, 60%, 70%, They were also claiming provision for losses of subsidiary companies. Provision for losses of subsidiary companies obviously is wrong because holding company cannot claim any expenditure for subsidiary companies expenses. Right. So if you see, that also has to be added back. It's a simple provision. Check here. Yeah. Similarly, dividend also, whether it is paid or proposed, dividend, whether it's paid or proposed, both should be added back because dividend is, not allowed. So it has to be added back. Provision for losses of subsidiary companies, that also has to be added back, my dear friends. Both should be added back. Dividend, it is generally proposed by the board of directors and it is declared by the shareholders. So if you remember earlier, the company used to pay something called as dividend distribution tax, and then it used to be exempt in the hands of the shareholders. But now, as you know, dividend taxation is there. Shareholders have to pay anyway. But nevertheless, dividend paid or proposed to be paid has to be added back as far as MAT provisions are concerned. Very, very simple. So this was one part of the deal. Next, let us see what all is there. Also, in this transfers of transfer to reserves, etc., you can just write down excess provision also has to be added back. For example, normal provision you make 10, but then later you find out that it should have been 8. The excess provision 2, that also has to be added back. That is, if they give an adjustment saying excess provision was 2 crore, excess provision was 20 lakh, that also has to be added back. So these were all the things. Then one more point you can write down, guys. This was asked in the MCQ. Here I'll write. So one is 2 other adjustments in MCQ. Excess provision. Second one, prior period expenses debited to P&L account. It is under Income Tax Act, it is grossly disallowed, not allowed, but hence it is here for MAT provisions, no need to add back because it is not neither a reserve nor a any other provision that you are adding. It is not provision for the diminution in the value of assets, nothing. So no treatment, no need to add back. These are 2 MCQ areas which they were testing. So please note these 2 things, guys. Please note these 2 things. There used to be some tax planning concerning revaluation reserve. Tax planning using revaluation reserve. Check it out. So company had an asset valued 100 lakhs. It was sold during the year 31st March 2023 for, let us say, 2000 lakhs. What would be the profit? 1900 lakhs. Instead of this, what company was doing? So basically to the P&L account, what is coming? 1900 lakhs on which MAT has to be paid. Instead, what company was doing? Company used to revalue the asset. Revalue the asset. By how much? Let's say 1890 lakhs. The moment they revalue the asset, they used to obviously pass the entry asset account to revaluation reserve account. 1890, 1890. Then when they sell the asset, What will be the journal entry? Bank account 2000 to asset account. How much? 1990. Because 100 was already there, 100 plus 1890 is 1992. Profit is 10 lakh. And then what they used to do, revaluation reserve to general reserve 1890. This was the tax planning that they were doing, my dear friends. To nullify this tax planning, here, clause number J was inserted. The amount standing in revaluation reserve relating to revalued asset on the retirement or disposal of such asset. Guys, on the retirement of disposal, anyway 10, but this 1890 is the amount which is there in the revaluation reserve account, that also has to be added. 1890 plus 10, basically reverse gear. 1900, you pay tax on 1900. Right? So that is regarding revaluation. Are you getting it, guys? Coolly, I'm explaining the logic of each and every point, becomes very simple. So we were discussing here, point number 10. Here. Amount in revaluation reserve on retirement of an asset, if not credited to P&L account. Have they credited to P&L account? No. Have they credited the same to P&L account? No. They have not credited. See here, where have they credited in this entire entry? Is it credited? No. P&L account not credited only. I told you, no, at the beginning. Clause number A to K, if debited to P&L account, add back. Clause number J, revaluation reserve, if not credited to P&L account, add back. So if you see the Bare Act, here nothing is given in J. Sorry, here J nothing is given, but here below, see here, any amount referred in clause J not credited to P&L account, add back. Are you getting my point? So clause number J is this, revaluation reserve. Revaluation reserve is not credited to P&L account due to this entire scheme or scam that they were doing. Hence, you have to add back. Revaluation reserve was not credited to P&L account. Hence, we have to add back. Hence, you have to add back. These three will do. Everything will do. This also requires examples. We'll see. Let's see the amounts credited, guys. Amounts credited here. As reduced by. As reduced by the amount withdrawn from any reserve or provision, excluding a reserve created before the first day of 1997 that you leave, and the amount withdrawn from any reserves or provision, if any such amount is credited to P&L account. If any such amount is credited to P&L account. So just like we saw the debit side, reserve which is debited, if it's credited also, I am cleaning. So as reduced by, in P&L account, manufacturing profit is 10 lakh. transfer from reserve credited is 7 lakh. 7 lakh to be reduced. 7 lakh to be reduced. So how, why, what? So the company is making this much, 10 lakh and 17, totally 17 lakh. So let me take another example. Let me make it 5 lakh, 6 lakh, overall 11 lakh. How did they make this? Very simple. On manufacturing goods, they were making 5 lakh profit. On sale of investments, they are making 6 lakh profit. On sale of investments, they are making 6 lakh profit. Overall, it was 11 lakh profit. Profit on sale of investments was made on 36/2022. Assume company on 36/2022 passed an entry. What? Profit on sale of investments 6 lakh to reserve account 6 lakh. Then what they did? Reserve account 6 lakh to P&L account 6 lakh. Here, P&L account 6 lakh. So, is this as per schedule 13? Yes, very much as per schedule 13. So, as per the statement of P&L account now, what will I do? The here net profit is coming up to 11 lakh. But then 11 minus 6, I'll have to subtract now obviously because it's there in the law. 11 minus 6, it is 5 lakh. 5 lakh. Mind you, this was 36/2022. Whereas profit and loss account here when I'm making, it is 31st March 2022, 23, sorry. 31st March 2023. So now, so guys, same here, if you think about it, I am just directly subtracting it. Here nothing was added before, nothing was added now, nothing will be added in the future. See, I'll tell you, for example, this you see, you will understand. See, I had made provision for bad debts, 200 lakh. Provision for diminution in the value of assets, 250 lakh. So overall 450 lakh. As you know, provision for bad debts, diminution, etc. should be added back. Let's say this happened on 31st March 2019. Was it added back already? Yes. Basically, that effect, tax effect has already been taken into. Today, on 31st March 22, today, you have credited the P&L account. Provision for bad debt not required anymore. Provision for diminution in the value of assets not required anymore. You have made it, let's say, 180 lakh and 120 lakh. This is not required anymore. Overall 300 lakh. This, since you have already added and paid tax on it, here subtracting it makes sense. This one, reserve, subtracting it makes sense. But if you have not at all added in this particular example, you see, I just did one scam. Profit on sale of investment transferred to reserve to P&L account. I did this 6 lakh. Have I charged this 6 lakh anywhere, anytime before? No. So when I have not charged it to tax, or rather when I have not debited, whereby I have added it before, I have not disallowed it before, now I am subtracting it. So earlier also I did not pay MAT on the 6 lakhs. Now also, in fact, I am reducing it from the total net profit, which is scam. So though it's a very good provision, if where it was debited, you subtract, that makes sense. Whatever was debited before, if it's credited, then reduce, then it makes sense. But here, it just said like that. So lot of tax planning was happening, guys. So basically to nullify here. Where this section is applicable to an asset in any previous year, amount withdrawn from those assets created or provisions made shall not be reduced from book profit unless the book profit of such year has been increased by those reserves. Increased by those reserves. Which means what? Which year? Such year. Such year means which year? The year in which reserve or provision was made. So they are trying to tell, in that year, was a reserve or provision already made that year? No. In this example, was a reserve or provision made that year? No. If it was not made that year, if it was made that year, I will add back. And here I'll subtract, fair enough. Or in my example here, that year, was it made? Yes. Later on, will you subtract it? Yes, because I've already given the effect there, makes sense. But here, scam entries like this, intention of law is very simple. Scam entries like this, not allowed. So what do you mean by that year? Previous year in which the reserve or provision was made. Was 6 lakh added before? No. If it is not done so, nothing can be done. So in this example, was 6 lakh added? No. Where the section is applicable in any previous year, the amount withdrawn from reserves created or provisions made in the previous year shall not be reduced from the book profit. 6 lakh will not be reduced if or unless the book profit of such year has been increased by those reserves out of which the said amount was withdrawn. So it should be a matching concept. Either under this explanation or explanation below the second proviso on 15J, your deemed income. Whatever the case may be, guys, very simple. Logically, you think if that year you have debited and you have added back, and again you have credited whatever is not needed, then you clean the balance sheet P&L. But doing scam entries like this, not allowed. Doing scam entries like that, absolutely not allowed, right? So this was the next provision, so to speak. See here. Amount withdrawn from any reserve if the same was created through P&L account. Simple words we have created. Amount withdrawn from any reserve, the same was created through P&L account. This you remember and go. Because if it was added before, now I'll allow you to subtract. It was not added before, not allowed to subtract. You write this only and go, no problem. Amount withdrawn from any reserve, the same was created through P&L account. Yes. Amount exempt under 10, 11, 12. So all these section 8 companies, then your agricultural income, all these things, that is the second point, guys. Income exempt under this shall be subtracted. So basically, if my expenditure is, let's say, 30 lakh, manufacturing is income is 50 lakh, agricultural income is 60 lakh, expenses from agricultural income is 20 lakh. Then we had seen here also expenditure relating to income under 10, 11, 12. That's why I have to do it together. Point number 6 here and point number 2 here. So basically what they are trying to tell here, 60 will be subtracted, 20 will be added. Basically you knock off these two is what they are trying to tell. Ultimately it will be this only. Ultimately it would be that only. So let's see the note here, note number 2. So guys, amount to which any of the incomes or expenditure under these three sections 10, 11, 12. Interesting to note that section 10 AA is not covered under exempted income. So basically amount with which 10 AA income etc. if you get, it will not be subtracted. Similarly important again, ATIA, ATIB will not be subtracted. So basically foreigners, I enticed the foreigners to come to India and told them under ATIA for 10 assessment years everything is free and all that. But later MAT was introduced and they said you have to pay tax 15%. They said this is cheating. Chidambaram said, sorry bro, sorry, but no choice. That's why Nirmala madam came and she introduced 115 BA, BAB saying that if you follow that, MAT will not come. Remember, if you follow that, MAT will not come. Try to follow. There I'll give you ATIA also. All that little bit, level playing field was created. But ultimately, basically ATIA is subject to MAT. Means they have to pay MAT. Got it? Yes. So guys, 10 AA is not exempt. ATIA not exempt. ATIB etc. Full ATIA series not exempt. Please note. It's easy guys. MAT is very easy. So now, continuing this, if company is a partner in a firm, his share of profit, that is company share of profit, is exempt under section 10. 10(2)(a) especially, right? So since it is exempt under 10(2)(a), that share that a company is receiving, in the company the share that it receives from any partnership firm, that would be deducted. Because if you see here, income exempt under 10, 11, 12 are exempt. I mean, should be deducted. They're deducted. But if the same company happens to be a member of AOP, share is exempt because AOP pays, if you remember guys, taxation of AOP, please recall, taxation of AOP, AOP pays MMR. Since AOP pays maximum marginal rate, the share of such profit from the AOP or share of income etc. is exempt under section 86 and not section 10. So basically in the balance sheet and in the P&L account, if I receive any share from AOP, this is under section 86 exempt. But if you see in this provision, only income exempt under section 10, 11, 12 should be deducted, which means this was not allowed to be deducted only because this is a AOP and this is a firm. If one is a firm, no problem. One is AOP, problem. They said cheating. So Chidambaram said, okay bro, I will change it. See now, here, separate point he added, share from AOP BOI, not chargeable to tax. Share from AOP BOI, not chargeable to tax. Similarly, expenses related to AOP BOI to be added. Very easy, guys. Chiller. Point number 1, income tax payable, provision for income tax, interest. Point number 2, transfer to reserves. Provision for unascertained liabilities, dividend paid or proposed. Losses for subsidiary companies add back. Income exempt under 1011 add back. AOP add back. Deferred tax, provision for deferred tax add back. Provision for diminution in the value of asset, that is provision for bad debts, add back. Amount in revaluation reserve on retirement if not credited to P&L account, add back. And subtractions, amount withdrawn from any reserve, subtract. Income exempt under 1011 subtract. Share from AOPBI, subtract. Got it? Now, let's check. Depreciation. P&L account as on 31st March 23. Expenses 40 lakh. Depreciation 25 lakh. Net profit here. Sales 200 lakh. Net profit 135 lakh. 200 tally. Now, company revalues assets by 300 lakh. Depreciation rate, let's say, is 15%. So what I'll do, this again was done by Ambani. Case number 1, case number 2, case number 3. Case number 1, P&L account. Expenses will be 40 lakh only. Depreciation 15% on 300 lakh. 25 lakh is already there. 15% 45. 45 plus 25, 70 lakh. So here depreciation I will show 70 lakh. And sales I will show 200 lakh. Then amount withdrawn from what? Revaluation reserve I will show 45 lakh. Net profit I will show 135 lakh. Right? This is what scam they were doing. Two 245. So this is what they were scam that they were doing. When they were doing the scam, what will happen? Right? When they were doing the scam, what will happen? Nothing will happen. Basically, I will take it as what? Here, I don't want to pay 135. So what I'll do, I'll claim more depreciation. And I'll say, I have not done anything. I've just, done all these things in a nice way. So I'll make 200 minus 45 minus 40 minus 70, reorganizing everything. In depreciation, I will claim higher. There is one scam. So I would reduce this also. Here anyway, if you see 200 lakh was there. 200 minus 40 minus 25. To that 135, I had to add 25 lakhs. Depreciation has to be added back. Right? Why? I'll tell you. So this is a combined reading of three sections. Clause 2A, 2B, and one more clause with respect to depreciation. So this scam they were doing. Case number 2 scam. Everything is nullified, guys, don't worry. Case number 2 scam. Sales 200 lakh. Expenses 40 lakh. Depreciation 70 lakh. Net profit 90 lakh. This was one more scam. In this, that 45 lakh they transferred to revaluation reserve account 45 lakh to general reserve account 45 lakh. In the third case, everything is the same, but assume expenses was 48 lakh. Thereby, your net profit, because of various things, net profit is also 138 lakh. Assumption. So now, guys, what does it say? Check it out. Three things. The law says all these scams, whatever you do, I will not allow. Everything will be completely nullified. How? Check it out. First, what we should do, see here. Add back the total depreciation. See, whatever depreciation you are charged, add back. Full depreciation should be added at any cost. Next, less. Here. Depreciation excluding the depreciation on revaluation of the asset. As an example on depreciation, we'll see. Depreciation excluding the depreciation on revaluation of the asset. And next, amount withdrawn from revaluation reserve and credited to P&L account to the extent it does not exceed the amount of depreciation on account of revaluation. One is what? Amount withdrawn from the revaluation reserve. One more, depreciation excluding depreciation on revaluation of asset. You see, and first add back the depreciation. So, let's see. Case number 1. What should I do? Net profit is 135 lakh. Add back the depreciation of 70 lakh. Less. Depreciation on account of depreciation, excluding the depreciation on revaluation. So, revaluation, because of revaluation, it has increased by 45, but what was originally 25 lakhs. So I should subtract what? 25 lakhs. Next, amount transferred from revaluation reserve to the extent of depreciation. See, amount withdrawn from revaluation reserve and credited to P&L account to the extent it does not exceed the amount of depreciation. That we'll see. So basically 45. So my depreciation 45 lakhs. Same it comes to 135 lakh itself, which you would have paid anyway here. Status quo. Reverse gear. Here you see. Here. Net profit 90 lakh. Add back full depreciation 70 lakh. Subtract depreciation, which is excluding the depreciation out on account of revaluation, that is 25 lakh. Other one was what? Amount withdrawn from revaluation reserve and credited to P&L. Is anything credited to P&L here? No. So nothing to be subtracted. So if you do this also, 90 plus 70 minus 25 is also 135 lakh. Same, no change. I will pay on 135 only. You cannot show less here 90, 135 only. On the other hand, you see, if the net profit was 138 lakhs, 138 plus add back depreciation 70 lakh. Minus how much, guys? Depreciation claimed as per the, without revaluation. Next. What is the amount withdrawn? I told you. Sorry, my bad, guys. Not expenses, not expenses. This one. Sorry. Not expenses. Amount withdrawn. Amount withdrawn from revaluation reserve account was 48 lakhs. You see. Total depreciation was 70, which is the same. 25 lakh is depreciation without revaluation. Because of revaluation, that extra is 45 lakhs. Overall is 70 lakhs. I am saying the amount that you have withdrawn, instead of 45 lakhs, you have withdrawn 48 lakhs. You can withdraw any amount you want. So here they have withdrawn 48 lakhs. The question is, when I am subtracting here, should I subtract 48 lakh or should I subtract 45 lakh? That was the question. See the wordings. Amount withdrawn from revaluation reserve and credited to P&L account, that is 48 lakhs is actually withdrawn as per my example. To the extent it does not exceed the amount of depreciation on account of revaluation. What is the amount of depreciation on account of revaluation? 45. So maximum you can withdraw is just 45 lakhs, or rather you can subtract maximum is 45 lakhs and not 48 lakh is what I am saying. So similar example, see, this one is there. So you can check this out. Same. You will understand this. Do this example, guys. Go through this, you will understand. Whatever I did, different example, you do this. Simple. The extent of, you will get it. Read it, okay? Do similar example. Please solve it on your own. It's easy. Yes, next. Solve this one. This point. Note number 3. We'll see this. With the adjustment, I'll just read the bare act now for you. Point number 7, guys. Check it out. Clause 3, it will come under this one. The amount of loss brought forward or unabsorbed depreciation, whichever is less as per the books of accounts. In case of a company other than the company referred to in 2H. We'll see 2H later. So loss before depreciation 3 lakh. Depreciation itself is 8 lakh. Total loss after depreciation is 11 lakh. So how much should be subtracted? That says that the total amount of loss brought forward or unabsorbed depreciation, whichever is less. So people are asking, should it be 8 lakh, 11 lakh, whichever is 8 lakh, or should it be 3 lakh or 8 lakh, whichever is less, 3 lakh? Litigation happened. When I say loss, is it loss before depreciation or total loss? Unabsorbed depreciation is 8 lakh. So unabsorbed depreciation 8 lakh or loss, whichever is lesser. Loss, should it be 11 lakh or 3 lakh? Should I take 8 lakh or 3 lakh, whichever is lesser? That's what the question was. So they added an explanation. Here, loss shall not include depreciation. And the provisions of this clause shall not apply if the amount of loss brought forward or unabsorbed depreciation is nil. So here, loss will not include depreciation. So basically, guys, it will not be 11 lakh. It's 3 lakh or 8 lakh, whichever is less, 3 lakh. See here. Business loss 12 lakhs, unabsorbed depreciation 17 lakh. So basically, it is what? 12 or 17, whichever is less. Business loss 5, unabsorbed is nil. So that also says if it is nil, it should be taken as nil. Whichever is less is nil only, no? Business loss is nil, unabsorbed is 14, so it will be taken as nil. It is not business loss and unabsorbed depreciation 27 lakhs loss, 29 lakhs loss, no. On the other hand, guys, business loss and unabsorbed depreciation both will be allowed as reduction, means both will be reduced if the company and its subsidiary or subsidiary of the company, basically that entire holding company with subsidiary 1, subsidiary 2, the entire thing has gone under 241 and 242. This is compromise and arrangement under Companies Act. Under compromise and arrangement, what will happen is, I will go to the tribunal. I'm sorry, not compromise arrangement, it is oppression and mismanagement. 241 and 242 is oppression and mismanagement, whereby the shareholders will go and seek the help of the tribunal, National Company Law Tribunal, telling that, sir, the company is going through mismanagement and there's a lot of oppression. So please throw out the directors and appoint new directors in their place. Company is already going down, so directors also have committed some fraud, etc. So the National Company Law Tribunal will come and appoint new directors. This happened in Mahendra Satyam case when Ramalinga Raju, Satyam case, when Ramalinga Raju went and told, I committed fraud, immediately government told the NCLT and NCLT appointed directors under this section of the relevant old Act 1956. So that be the case for MAT. First of all, the company is going under loss. If I just subtract depreciation or unabsorbed or loss, it will be a problem. So they said both you can subtract, no problem. Second, if the company is going through IBC, Insolvency and Bankruptcy Code, they have applied for something called as CIRP, Corporate Insolvency Resolution Process. That be the case. In both these cases, what will be allowed, guys? Business loss as well as unabsorbed depreciation. So here, and the company is got under exception. So what? 12 plus 17, 29. 5 plus 0, 5. 0 plus 14, 14. Hope you got this point. This is the extra benefit that is there. Got it? Cool. Got it? Done. So guys, now abruptly I'll change the topic. Why? You will definitely know why. See 13.1. Because to do something in MAT, We need to understand this. Okay. 115 BBF. 116 BBF. So 115 BBF is tax on income from patents. So in this case, where the total income of an eligible SSE, who's an eligible SSE? Guys, patents, obviously for Make in India concept, more and more people who are resident in India, who make anything which is sold across the world, patented, then whatever money is getting, rather than paying the normal rates, concessional rate is given under 115 BBF. Check it out. Eligible SSE would mean a person resident in India who is in true and the first inventor of the invention and whose name is entered on the patent register as the patentee. Where the total income of an eligible SSE includes any income by way of royalty in respect of a patent developed and registered in India. Developed means what? 75% of the expenditure should be incurred in India by the eligible SSE as per the Patent Act. So basically, Make in India benefit. What benefit will I give? So guys, if you opt for it, where an eligible SSE in respect of any previous year opts for what? 115 BBF. Opts for 115 BBF. If the SSE offers the income, royalty or for taxation not in accordance with this section for any of the 5 consecutive years, then the SSE would not be eligible to opt for concessional rate for 5 years subsequent. So basically there's a lock-in. So if you do not do in accordance for 5 consecutive assessment years, then you will not be eligible for 5 assessment years subsequent. That you leave. But what is the rate? Rate is very simple. 10% on such income. No PGBP, normal slab rate, 30, 40, 35% surcharge, nothing on that. Make in India concept, new section 115 BBF. Deduction of any expense from the royalty income is obviously not allowed. Direct, whatever is income into 10%. You can opt for the concessional rate, and to exercise the option, you should do it on or before due date of filing the return of income. If you don't do it, then for any of the 5 assessment years in once also, if you miss out by doing this, if you are not opting it on time, and if you break the rules as laid down for this section, then you will not get this concessional rate for 5 more years. From the year, it will be considered as opt-out, and from that opt-out scheme, 5 years you will not get. But guys, interesting to know that you will also get deduction under 3 lakh of under 80 RRB. That also you will get deduction, so no tension. Even if opted for 115 BA, then also it is 10%, mind you, important to note, and not 22%. If you opt for that 115 BA individual, no MAT also. No MAT also. This is why we discussed. Now you come here, you will understand. Understood this point? 13.1. Now you come to our MAT provisions. Why this fellow went off to this provision, you will be wondering, because of this only. See here. Here. Expenditure relating to royalty, income, taxable under 115 BBF, add back for a company. Here when in the when I said 115 BA, it is the 22% for domestic companies lesser rate. Since MAT is there, I told individual, sorry, that is 115 BAB, that is different. I'm talking about BA. BA is for companies. Remember the reduced tax rate 22%. So there also MAT will not be there, because MAT is only applicable for companies. So if you see here guys, I told individual, don't get confused. 115 BA is for companies. So if you see, slip of tongue, my bad, sorry. Expenditure relating to royalty income of patent taxable under section 115 BBF. So this is to be added back. Similarly here, income by way of royalty on patent taxable under 115 BBF, subtract. To be subtracted. Very simple. Foreign company started crying. Foreign company started crying, saying that, boss, you are not giving me any benefit. You told me everything is free, now you are charging MAT. They had certain problems. They said, if you remember, revision in capital gains you had done 1112A. If it is long-term capital gain on shares where STT is paid, generally I'll pay 10%. So if it is again LTCG on zero coupon bonds and listed units, again it is 10%. In case of royalty, fee for technical services under 115A of income tax, we have seen international taxation, it is 10%. Certain interest incomes as per 194 LC and LB taxed at 5%. Dividend income under 115 AC 10%. All that you are charging 10%, and now MAT you are stamping me 15%. How is it fair? Do something, bro. They begged. For that begging, this provision came. In case of foreign income, they told if you are earning capital gain, interest, dividend, royalty, etc., the percentage, if it is less than 15%, like this, percentage is less than 15%, all these cases, do not worry, MAT will not apply. All the expenses you add back, all the incomes you subtract. Simple. So that these will be taxed separately at that 15%, whatever, 10, 5, whatever it is. I'll tax there only, don't worry. But let's clean the P&L account. Let's clean the P&L account. So if you see, in case of foreign company, expenditure relating to capital gains arising on transaction in securities or interest, dividend, royalty, fee for technical services chargeable under special rates discussed. Similarly here, in case of foreign company, income relating to capital gains, interest, dividend, royalty, fee for technical service chargeable to tax under special rates. Only if income is taxable under the general provisions of the Act is at a rate lesser than MAT. These examples. If these rates are lesser than MAT, then only for foreign company only, guys, mind you, foreign company relaxation given because they were crying. Foreign company relaxation was given. Understood? Guys, the previous session we did business trust, if you remember. That's why, guys, everything is in a proper sequence so that you will have no tension. If you remember, we did international taxation, then we came to this because international taxation, did we see any of these things, MAT and all? We just did foreign trade a little bit, but then MAT really was not needed in international taxation. So we completed all the major areas, small areas we're doing. But this area also, like business trust also, questions will come. MAT Pakka questions will come. So we are doing everything together in a proper sequence. I hope you are able to appreciate it. Sir, forget about appreciating. I hope you are able to understand. Now you see. Remember guys, business trust, how it works. Unit holders, REIT will issue units to the business trust. Exchange of shares in return for the units. And this would be a company. I gave a mall example, special purpose vehicle. And that will be transferred to this business trust, real estate investment trust. We had seen that. So anything for that matter. So we had seen it. So I had given you that Rajini example. So basically, create will give units in exchange for shares. Let's say this is Rajini Boss Limited. Rajini Boss Limited held shares in Rajini Limited. 100%. And Rajini Boss Limited gave all the shares to REIT and REIT issued units. As we discussed, when it issues units, for them, no tax under 47(17). When allotted, no tax. But when Rajini Boss Limited sells these units, then the capital gain will arise. This is as per Income Tax Act. But as far as MAT is concerned, they will be making some money here. For example, if the unit was initially purchased by Rajini Boss at, the shares was initially purchased at 100 rupees. Now the unit value for that, whatever you are getting, is 1000 rupees. Think about it. What is the capital gain? 900 rupees per share or per unit, whatever it is. This is not taxable at the time of conversion. But if this 1000 rupees is sold at 2500 rupees later, we have discussed what is the cost of acquisition? 1000. Or is it 100? Remember? What would be the cost of acquisition? Cost would be whatever its cost was there. That is basically you should always take in capital gain only we have seen, guys, if I give a building and take gold in return, what would be the sale consideration? FMV of the gold. And what would be the cost in the future? Same thing. So if you see, I'm just asking 1000 units, 1000 sort of value, 1000 was units was given in place of shares purchased at 100. There was a notional gain of 900 here. Similarly, this 1000 was sold at 2500. There was a gain of 1500 here. But technically, the overall gain is 2500 minus 100. That is 2400. That is 1500 minus 900. The problem is some assessing officers where though the capital gain was exempt here, the profit when you are recording, so this will be 2018, this will be 2020, this will be 2023. As per Income Tax Act, capital gain will arise only here. There is no doubt about it, because this is exempt. But for MAT provisions, will I pay tax on 900 in 2020 was the question. Or will I pay tax on 2400 in 2023 was one more question. Or should I only pay on 1500 is a third question. Full confusion. Right? So we are going to discuss here. Amount representing notional gain on transfer of shares of SPV to a business trust in exchange of units allowed by trust. In my example, this is notional gain on transfer of shares 900. Notional gain resulting from any change in the carrying amount of such units. Actual gain on transfer of units of business trust. Loss on transfer of units of business trust. So if you see, there is an example here, but better example, we'll do a more in-depth example, no problem. Let's see. Whatever I do now, the ulta, this is notional gain. Notional loss is here, obviously reverse. That is also covered. Same. Reverse. Once we understand this, the reverse will be that. Nothing to understand in that. Let's see, guys. So this will create an example. Illustration on notional gain of what? Business trust. First one. Manufacturing profit. 500 lakhs. An examination modified question this is. That's why I'm doing it here. Not even an examination. It's somewhere in MTP or RTP. In exam it is still not come. Cost of shares of SPV in India. Shareholder. Shareholder is a company. Only then MAT will come, no? Rajni Boss Limited has acquired Rajni Limited. And Rajni Limited is the SPV. Rajni Boss Limited is the shareholder who's the sponsor. That sponsor now is giving away the shares to REIT. And REIT is issuing units. I hope the entire thing is clear for you. Now this is 1000 lakhs. Third, shares transferred. Units allotted. Face value 120 lakh units at 10 each. 1200 lakhs. But market value 11 rupees per unit. Units sold 31/3/2021. This one happened on 1/1/2020. Cost of shares 1/1/2014. So 14, 20, 21. Sold at 20 rupees per unit. So how many units given? 120 lakh units into 20. So 2400 lakhs. So as per ICDS, when a security A is exchanged with security B, I should record it at FMB. This is what we saw in capital gain also. Should be recorded as at FMB only. So here, what are the units in business trust? What are the units of business trust here? What is the units that I have purchased? $120 lakh into 11. I will use it as FM. FM is 11 rupees. So units of business trust that are 120 lakh into 11. 1320 lakhs. 2. Shares in SPV account. How much is the shares, guys? Cost 1000 lakh. Now, what is the notional gain? Profit on sale of shares 320. This is what the law says CG is exempt. Has it been realized now? No, just on conversion. Book entry I'm writing. This 320 will include two things. One is what? 120 into 1 rupee notional gain. 120 lakhs market value. Remember, one more is what? The other one is what? On exchange of shares. So basically 120 remove from here. 120 is just an extra thing. So remaining is what? 1200 minus 100. So 200 lakh is actual profit on exchange of shares. Obviously, no. 120 is just a notional profit at 1 rupee extra. Notional gain. Because I am recording the units at FMB, notional gain. 200 lakh is what? The actual profit that you make. But both are not yet realized, mind you. Next, at the time of sale in 2021, bank account. How much? 2,400 crore. 2 units of business trust. This will go 1,320. And to profit. How much profit I'll make? 1080. For income tax purposes, cost of these units will be taken to be cost of the shares for income tax purposes. Holding period will be whatever was held by the previous guy. That is that same, that company, that only will be taken. So for income tax purposes, holding period will be 1/1/2014 to 30th March 2021. Here 1/1/2014 to 30th March. Period of holding should be 1 day before always. Remember, 30th March 2021. Cost of acquisition will be taken as 1000 lakhs. LTCG will be on how much? 1400 lakhs. 2400 minus 1000 at 10%. STT is paid 10% under 112A. This is the entire scheme of things. Company has manufacturing profit of 500 lakhs also. Manufacturing profit is 500 lakhs. And what is the profit on sale of units, guys? Here 1080 lakhs. Are you getting it, guys? Coolly, I've written all the entries. Go through it again. You see now here. this A and B, no, this will be year 1. What is year 1? Allotment of units in exchange of shares that I have to subtract. This one, C. This will be the year of sale. When those units are sold, this has to be taken into account. How it works, you see how it works. Very simple. What used to happen, for example, year 1 you take, year 1. Year 1, manufacturing profit is already 500. I've already taken into account. And what is the notional gain that the company is profit on sale of shares here? This one, 320. This one. This also happens in year 1. So in year 1, 320 also will come. This 320 is split into 200 and 120. Overall, guys, the MAT would have come to 820. Total income for MAT would have come to 820. This only is a net profit, 820. This is wrong, right? Because it should only come in capital gains, it is exempt, but here it's not exempt. So what are they trying to tell? From this income, you reduce these two. Now you read. Notional gain on transfer of shares of SPV to a business trust in exchange of units allotted by trust. 200. Notional gain resulting from change in the carrying amount, 120. 10 rupees to 11 rupees, 120. So they are trying to tell in this particular year, if 820 is the net profit, subtract 200, subtract 120. See the next point here, the other point will it come, you see. Actual gain on transfer of units. Has the units been transferred? No. Actual gain, when it happens? Later. So here, minus nil will come. Does not happen. So overall, how much, guys? Ultimately, I am paying on 500 only. I am paying on 500 only, no change. I am paying on 500, no change. Right? You see book profit, what will it be for the year of sale? This is the book profit. You get 2,400 crore. Units of was 1320 and profit was 1080. So on the year of sale, I assume manufacturing profit to be 500 lakhs or whatever. Then profit on sale of units is 1080. Overall, how much? 1580 profit. Now from this I have to subtract certain things. What should I do? Check it out. First and foremost, guys, net profit as per profit and loss account 1580. To this I need to add, see here, this part. Here, gain on transfer of units of the business trust. Gain on transfer of units of the business trust means what? What is the gain, guys? We have done the capital gain already here. See, gain, selling price 2,400 minus cost is 1,000, gain is 1,400. So add gain 1,400 less. What should I subtract? One is this part. What should I subtract? These two. Notional gain on transfer of shares of SPV to a business trust in exchange of units allotted by trust. Notional gain resulting from change in carrying amount of such units. 200 plus 120. Will it come here or it has already come? It has already come. So here it will not come. Second. Gain 1400. Less what? Notional gain. $300 has already been taken here, guys. 200 and 120 already taken here. So here will not be taken. But here I told you one more subtraction is there here. Come back. Here one more subtraction is there. Actual gain on transfer of, sorry, not this. Sorry, here only, sorry. Actual gain on transfer of units. So what is the actual gain on transfer of units? Not the notional gain, actual gain. That is this profit. 1080. So if you see overall it comes up to 1900. So the book profit will be 1900. Guys, very simple, nothing to worry. You just take the net profit as per P&L account, add as per clause K, that is the gain. That is whatever CG was exempt. Capital gain which is exempt, that you have to add. Less notional gain. Less actual gain. This actual gain will come in the year of sale. This gain, wherever CG was exempt, this also will come in the year of sale. Whereas this one will come under in year number 1. Now you see, net profit 820. This is in the year 1. Plus gain, capital gain which is exempt. That should not be added anything. Minus notional gain, because it's already credited here, no? Notional gain 200. One more notional gain because of FMB 120. Minus, so that's what I told you here, year 1. Actual gain. In that year 1, is there any actual gain? No. So overall 500. Basically, instead of 820, I'm paying on 500 only. Point number 1. Point number 2 is in the year of transfer, P&L account is 1580. I will add the gain, overall gain that capital gain that I have to pay, which is actually exempt. Which actually was exempt, right? Which actually was exempt. Now I have to pay, no? This actual gain, 2400 minus 1000. 1000 was the cost, 2400 was the selling price that I have to add. Here you can write what was exempt before. What was exempt. So here also 820 plus nothing was exempt that time. Minus notional gain, minus this thing, minus nil, 500. Here 1580. Add the actual, the gain that you got now, 2400 minus 1000, 1400. Subtract the notional gain. Nothing to subtract, already subtracted before. And actual gain. Actual gain is 1080. Here, if you see, actual gain is 1080. Why? Because the unit was recorded at 1320. So books, actual gain in the books is just 1080. So that I have to subtract. So guys, basically this was the gain as per income tax, 2400 minus 1000. This is the gain as per actual gain as per the books. So that differential only, which I did not tax here, 820 minus 500, 320 I did not tax there, but I am taxing it here. See the difference? It is coming up to 320 only. That is all the logic is, very simple. Simply it looks very complicated, but what was not taxed back then is taxed now. That's it. So P&L account book profit is different. So that book profit I will take. To that I will add the current gain as per Income Tax Act. Subtract the notional gain which was taken into consideration before. I have already subtracted it. I will no need to subtract here again. I have already subtracted before. Plus the actual gain as per the books of accounts. Actual gain of the books of accounts is this only, 1320, which I have recorded it, and 2400 crore, 1080. Ultimately the difference between the two, 1400 and 1080, is anyway 320, which I have to pay now. Basically earlier instead of 820 I paid on 500. 320 was still pending. So now I am paying 320 extra. That's all there is to it. 1580 is the net profit, book profit, plus 320 what I did not pay before, overall coming up to 1900. They are showing it like this. That's all. This is just the difference between 1400 and 1080. Clear, guys? That's all there is to it. Check out. Same. No need to get confused. It's quite simple. Reverse of that will be loss. If it's a loss, totally you do the reverse. That's it. Then amount of profits of Sikh Industrial Companies Act. That after IBC has come, this is useless. So all the profits of Sikh Industrial Companies Act we should subtract, and because for that it goes into a concept called BIFR, Board for Industrial and Financial Reconstruction. That's why all the profits of Sikh Industrial Companies Act should be subtracted. No MAT on that. Special exemption for that. Very simple. So if the apart from that, let's see. AS India compliant later we'll do, guys. The next class we'll do. Some additional points here. Page S6. All other provisions of income tax shall be applicable to every company mentioned in 115 JB. So earlier, there was total income was there of, let's say, 10 crore, book minus 10 crore loss. Book profit was there of 3 crores. Since they used the word notwithstanding, they said no carry forward, nothing will apply. Tax should be paid on 3 crore, but no carry forward will apply. So many decisions were bad. It was nullified through various provisions. This is nothing but 115 JB 3, 4, 5 and all those things, all these points. All other, when I use the word notwithstanding anything contained, it only overrides the conflicting provisions. It doesn't override the entire act. So all other provisions of Income Tax Act shall equally be applicable to every company mentioned in section 115 JB. Levy of interest under 234A, B and C on account of violation of provision should be levied in respect of tax computed under book profit also. Company to which MAT applies shall be liable to pay advance tax. Interest under 234A, B, C, penalty for misreporting, everything will apply. Similarly, determination of amounts in relation to relevant previous year to be carried forward, subsequent years, all this will apply, shall not be affected. Basically, carry forward it is 8 years here, correct? 8 years as per Income Tax Act. But here there is no such provision. So does it mean it overrides the carry forward also? No, nothing like that. Every company to which the provisions of 115 JB are applicable shall furnish a report in 29B from a CA. Where accumulated, this what? When accumulated business loss and unobserved depreciation pertains to more than 1 year, CBDT has clarified that comparison between the two has to be made on cumulative figures and not year on year. So if you see, company has furnished the following business loss, unobserved depreciation. Should I do this, compare each of these things, or should I do overall? It says overall. 18 lakh of unobserved depreciation shall be allowed to be reduced from net profits to compute book profits. So what is allowed? Business loss or unobserved depreciation, whichever is less, right? So here I should compute on an overall basis. This is an examination question also in May, if I'm not wrong, 18. I'm not sure about the year, but once or twice they have asked this question. It is always to be done on overall basis. Always to be done on overall basis. So there were many cases, Apollo Tires, Malayalam Manorama, in all these cases they said that assessing officer cannot have the right to touch the books of accounts that you have already prepared. Once you have prepared the books of accounts, you cannot go and pass an enquiry into the books of accounts like that. Whatever is there, it has to be blindly accepted. See, here is given. The AO cannot recompute profit once the financial statement are approved in the general meeting. Adjustments can be made only to the extent permitted under 115 JB. Then prior period expenses cannot be added back, already discussed. Provision for tax made by foreign branches are to be added back to net profits at arriving at book value. There is no difference between Indian income tax and foreign income tax. It should be added back. Lease equalization account was not in the nature of reserve and need to be added back. It is not in the nature of reserve and it need not be added back. Sorry. It's called lease equalization account, need not be added back. While calculating the total income under the income tax, required to take into account any capital gains under section 45. Capital gains reflected in the statement of profit and loss account will be part of the book profits. Capital gains exempted under 54 to 55 shall be reduced in normal computation, but not in computation of book profits. Obviously, guys, because I should take any capital accounts under capital gains under 45. If it claimed exemption, it is only for income tax purposes, not for MAT purposes. And here, provision for gratuity disallowed. Actual valuation considered not to be added back in terms of MAT provisions. Provision for bonus leave encashment allowed as per 143B, not to be added back. Bad debts allowed under 3617, not to be added back. Provision for bad and doubtful debts disallowed, here also added back. Expenses subject to 40A and 40, disallowed, here not to be added back. So these are some of the hidden points. Remember these and go. So Dhirubhai Ambani took up this guy's challenge, or Lungi Man's challenge, and he did one thing whereby, what do you say? He went to the shareholders and said, I am charging arrears of depreciation from 1974, whenever Reliance started, till today, 10,000 crore. And net profit will be 10,300 crore. Then transferred from general reserve, 10,000 crore. Depreciation, he charged arrears of depreciation, transferred it to general reserve. So when he was computing book profit, net profit 10,300 crore minus general reserve 10,000 crore. He just paid on 300 crore and washed his hands. Because arrears of depreciation, should it be added back or not? Nothing. There is no such provision on arrears of depreciation, guys. No need to add back. Only depreciation has to be added back fully, not arrears of depreciation. This went to the court, he won the case also. So, Dhirubhai Ambani was always one step ahead of the government. Always. Always one step ahead of the government. Last part of the story, MAT credit. Other things we'll see later. Excess tax paid under 115 JB over normal provisions, they should be read as MAT credit. So here I have paid 10 crore, normal provisions 8 crore. So 2 crore will be MAT credit. MAT credit can be carried forward for 15 years, immediately succeeding the assessment year. MAT credit can be set off when the tax computed under normal provisions for income tax is in excess of MAT. We'll see an example. In case of domestic company which exercise the option of special rate under 115 BAB or BAA, provisions of MAT are not available. Accordingly, set off unutilized MAT credit is not applicable for such entities. I told you 115 BAB MAT is not applicable. No interest is payable to the company on MAT credit available. The amount of tax payable is reduced or increased as a result of an order. MAT credit also shall be increased or decreased accordingly. On conversion of private company or unlisted public company into LLP, MAT credit shall not be available. Does not have the choice not to avail set off or defer set off. You cannot say next year we will see nothing doing. If it is an excess, you can take credit and next year it has to set it off. Examples. Tax on normal 6 lakh, MAT 10 lakhs. Tax payable, whichever is higher, 10 lakhs. So do you get credit 10 minus 4? Yes. 4 lakhs. Actually paid 10 lakhs. Balance credit 4 lakhs. Next year, 8 lakhs is normal income, 5 lakhs is MAT credit. MAT. What will you pay? 8. What is MAT credit? Normal, you have paid how much? You see here. Excess tax paid under section 115 JB over normal provisions of income tax. So see guys, if MAT amount paid is more, you will get credit. Here number 1. 10 out of 6, what will you pay? 10. So you will pay 10. Instead of 6, you will pay 10. So 4 lakhs you will get credit, which will be carried forward. Next year, 8 and 5. How much you should pay? 8 you will pay. But as per MAT, it is 5. Last year you have credit 4. How much will you actually pay? I'll only pay 5. No problem. Because I have credit. Last year 4 I have paid more. Out of this 4, I will take 3 lakhs this year. 5 plus 3. How much will I pay? 1 balance. Next year, 3 lakhs is this 5.5. So 5.5 I am taking. I have to pay 5.5. So I am paying extra 2.5. That will be the credit. How much is the entire amount paid? 5.5. So 2.5 plus 1, 3.5 will be the credit. Next, 15 lakh, 20 lakh. How much should I pay? 20 lakh. How much is the credit will I get? 5 lakh. Actually paid 20. So 5 plus 3.5, 8.5. Next year, 12 lakhs and 2 lakhs. How much is payable? 12 lakhs. But guys, I will take the full amount 8.5 lakhs as credit. I will utilize MAT credit utilization. So I should pay 12 lakhs, but I will take the credit of 8.5 lakhs. What is the balance tax actual payable? 3.5 lakhs. Very simple. FTC, if you remember, we have done it in international taxation, where a company is entitled to foreign tax credit under 1998 and is allowed against MAT. If FTC exceeds FTC admissible and against tax payable under normal provisions, FTC shall be ignored in computing the MAT credit. Tax paid in foreign country amounts to 40,000, for which tax credit can be claimed in India against MAT payable. Tax liability of the company as per normal provisions is 35,000 and as per MAT is 50,000. In this case, FTC credit shall be allowed against MAT. That is 50K minus 40K, 10K. Similarly, FTC against tax as per normal provision is in excess of such tax by 5,000. 35,000 minus 40,000, it shall be ignored. MAT credit is 10,000. Refer international tax discussion. We have done this fully there. Foreign tax credit. So the other part of it, small areas, we will finish off tomorrow and continue with other areas. Okay. Very easy, guys. MAT 2.5 hours we have discussed in depth. Everything we have covered. Please go through everything. Single point we have not left anything. Okay. Please go through. See you. Come on. Up top. Awesome. Hi buddies. How are you doing? So let's wind up with those final provisions, whatever we're doing, my dear friends. So let's come to MAT. If you remember, we're doing minimum alternate tax. So we did all the adjustments, if you remember. So many things we did. It was easy only, right? And we finished almost everything in MAT. Cool. So let's, if you remember this chart, when this page number is 2, we saw what all will be added, what all will be subtracted, everything we did. You can go through that video again to understand. Very, very simple. So today we'll do finish off MAT, then we'll do one chiller concept called AMT, and 2 chiller things which we have already done, amalgamation and demerger. At various junctures we have done. We have done amalgamation and demerger in PGBP, we have done it in capital gains, and we have done it in a little bit of other things. So little bit of set off and carry forward of that also we will do. Basically it's the revision of whatever we have done till now. So that we will finish it off, demerger and amalgamation. Then small concepts will remain, guys. Of course, set off and carry forward is a separate chapter we need to do. So all those we will do and wind up. As I told you before international taxation, we told that majority of the portions, all the important portions are covered. This is all like, miscellaneous items. Since it's there in the syllabus, we have to do, and questions may come also. You never know that questions will not come. Of course, in MAT, questions will regularly come. AMT, it will come. So everything is important. We will not, miss out anything. But what I'm trying to tell is the level of depth that, generally we used to do is not needed here, because this much depth is good enough. Otherwise, it will get too burdensome for you guys itself. Okay. So, sorry. What happened to this? Let me close this down. Cool. So essentially this is what we had. We had done all these provisions. Business trust and all we had done. So let me close that area. Right. So apart from these classes, let me see if I can record 10-15 hours more of Q&A. I'll try to do that. I'll try, guys. I'm not promising. I'll try my best. I'll either put it up on YouTube or I'll give it to your access here only. So keep a keen lookout on my YouTube channel for all these areas. Okay. So MAT we are done, guys. So if you remember, we had done all these things in the previous session. Let's come to this. Special provisions for Ind AS compliant companies. Ind AS compliant companies. So basically they are trying to tell that for Ind AS compliant companies, there is something called as, for computing book profit, just a sec. So this is the lecture 88. We'll finish off everything. For computing book profit, right? The net profit shall be taken. This is for Ind AS compliant companies. For computing book profit, net profit shall be taken. Net profit shall be taken before considering other comprehensive income, OCI, other comprehensive income. So in Ind AS, you will find this concept called other comprehensive income. So here what I should do, I should compute the net profit before this computation of OCI. And once I compute OCI, there are some adjustments that I have to do. That is what there is to it here. Check it out. The book profit shall be computed considering the following additional adjustments. Items, these things should be added, these things should be subtracted. First one. Items credited to other comprehensive income and not reclassified to P&L account. So guys, as per Ind AS, those items that you shift to what? Something called as OCI, other comprehensive income. You guys will know, in accounting, FR, you will know when this Ind AS is done by your faculty, you will know that what all incomes will go to the other comprehensive income. So those incomes credited there to other items rather credited to the other comprehensive income, not income credited, items credited there. If it is not reclassified into P&L account, in that be the case, then what should I do? I should add it here to clean the P&L account. So it should be in sync with Ind AS. That's what this particular thing says. So if you see, following items shall not be increased or decreased from the book profits. That is first one. These two are important, guys. Revaluation surplus from asset in accordance with AS 16 or AS 38. This asset would be your property, plant and equipment. Property, plant, equipment. So generally, guys, when you shift all the assets, etc., you will obviously take the FMV. So here, what they are trying to tell is, for instance, what they are trying to tell is, this is one part of the story. Second part is intangibles. Intangibles under Ind AS 109. So equity instruments, intangibles plus PP, property, plant, equipment. So basically, if the book profit is 100 lakh, I'll write here. Book profit is 100 lakh. The fair market value is 300 lakh. As per Ind AS, you should record it fair market value, right? So basically, this 200 lakh will be called as other comprehensive income. Ideally speaking, this is not adjusted. That's why it says add items which are not to be taken here. You see, general rule here. Items credited to other comprehensive income and not reclassified to P&L account. So from the book profit, you add those items. So basically, what you are trying to tell is aligning yourself to the Ind AS, you will have to increase your book profit by these items, because as per Ind AS, you should take that into consideration. If it is, as I told you, property, plant, equipment, and equity instruments, that is, I will consider as an intangible. In these cases, my dear friends, book profit is 100 lakh, FMB of that is 300 lakh. This 200 lakh should not be adjusted. Right? Mind you, it clearly says here equity instruments, which means debt instruments to be adjusted. Only equity, which means this exception not applicable to debt instruments. Not applicable to debt instruments. Not applicable to debt instruments. Okay, which means this OCI should be added if it's a debt instrument. But when an equity instrument, it's not to be added. Why, guys? Because it doesn't mean it will never be added. What they're trying to tell is, tomorrow, if I sell this entire share for, let's say, 360 rupees. So what is the book profit? 100. What am I selling it for? 360. So 360 minus 100. That is 260. This will be added later. This will be added later. So just remember, guys, items which are credited to, what do you say, P&L account, sorry, credited to comprehensive account, OCI, other comprehensive income account, but it is not reclassified to P&L account, I have to add back. For example, if I sell a debt instrument, book value 100, but FMV, bringing it into the book, so FMV is 300. That extra 200 I need to add back. However, just note that for these three items, asset, property, plant, equipment, intangibles, equity only, not debt. If there is any variation, this 200 will not be adjusted now. It will be adjusted later. 360 minus 100, 260 will be adjusted later. Did you get it? Cool. So that's what they are trying to tell. Next, gains from changes in the fair value of equity instruments, already discussed through OCI and revaluation of surplus from assets, retirement, transfer. But as I told you here, on the above items, what above items? PPE, that is PPE, property, plant, equipment. It will be done only when the asset or investment is retired, disposed, realized, or transferred. All other assets, you have to make the adjustment here. All other assets, you have to make the adjustments here. Gain, whether it be a gain, whether it is, the fair value adjustment, right? They'll only give in the exam that it will be added to the other comprehensive income like that, right? So then you should reclassify it. But other items like these things, plant, property, equipment, etc., should not be taken into account. It should be taken into account later. Amount debited to P&L account on distribution of non-cash assets to shareholders in a demerger as per Appendix A in Ind-AS 10. So if you see, any amount debited to P&L account on distribution of non-cash assets. So guys, on demerger, for example, if there is a company ABB, this was the first ever demerger in our country, it became ABB Power. So as we have already seen in demerger and capital gain, etc., the assets of this will be shifted to this. The period of holding will come from here, cost of acquisition will come from here, everything will come from here. So this transfer, when it is shifted, is not a transfer we had seen, right? So it is generally exempt. So basically, if, for instance, if I have transferred assets worth 50 lakh, but the fair market value is coming up to 75 lakh, that extra 25 lakh will be exempt. But here, my dear friends, I need to add it. Amount debited to P&L account on distribution of non-cash assets to shareholders in a demerger as per Appendix A. That I have to add. So if you see note number 2, in a demerger, in a case of resulting company where the property and liabilities of undertaking received by it are recorded at values different from values appearing in the books of accounts, immediately before the demerger, any change in the value shall be ignored for the purpose of computation of book profits of the resulting company. So, though on top they say, right, here, what do they say? Book value 100 lakhs, FMV 88 lakhs, right? So, what will I do with that 12 lakh? What will I do with that 12 lakh? So that 12 lakh, my dear friends, it is an amount debited to P&L account that has to be added back. It has to be added back. On the other hand, reverse case. Are you understanding this? Amount debited to P&L account on distribution of non-cash assets to shareholders in demerger. Book value is 100, FMV is 88. So that 12 lakhs will be recorded in the book profit, which is a loss. But now I have to add it back because that effect has to be neutralized. Basically, effect of demerger has to be neutralized. as per the lawmaker. Makes sense also because that will give me my final book profit. On the other hand, it was reverse case. So the company which is getting demerged is called demerged company, that is ABB. ABB Power will be called as resulting company. So the book value is, let's say, 100 and the resulting company is, let's say, 250 lakhs. This 150 lakhs is the gain. This gain 150 lakhs is reduced from where? It is reduced from the net profit of demerged company or resulting company. Obviously, it is reduced from the demerged company. Correct? We'll see further about that. Check it out here. In a demerger, in a case of resulting company where the property and liabilities of the undertaking received by it are recorded at values different from the values appearing in the books of accounts immediately before the demerger, any change in the value shall be ignored for the purpose of computation. So if anything which is valued at 100 is being shifted at 120, that 20 will be ignored is what they are trying to tell. On the other hand, if there is a loss, reverse case, book value is 100, fair market value is 80, that 20 will be added back as per this. It will be added back as per that. Apart from that, as far as demerger is concerned, all this we saw. Additional point also we saw. Now this example, as I told you, this 100 lakh, 250 lakh, this 150 lakh. This gain will be reduced from where? So if you see here, shall be ignored for the purposes of the resulting company. Book profits of the resulting company means what, guys? This 150 will be subtracted from demerged company. Now tomorrow depreciation on the asset will be taken on 250 or 100. Because this 150 has been ignored, depreciation will be computed on 100. Depreciation will be computed on 100 and not 250. Hope you got the point. So guys, if the book value is 100, FMV is 88, this 12 will be added back as per this point. On the other hand, if the book value is 100, selling at 150, the 150 is ignored in the resulting company. Which means this will be adjusted with the demerged company. 150 will be subtracted from there. Very simple. And the depreciation will be on this 100 and not 250. That's what they're trying to tell. Very, very simple. So write down 2 points to explain this transition effect here. Guys, 1, 2, same point is you have to subtract if there is a loss. Here it's item credited to other comprehensive account. Here item debited to other comprehensive account. And here it is gain, it is loss. It's the same. But what is this 1/4 of transition amount? We'll see. That is what we have to discuss. So write down. When company adopts Ind AS for the first time, let's write down. When company adopts Ind AS for the first time, comma, the transition difference is transferred into a separate account in the balance sheet. The transition difference is transferred to a separate account in the balance sheet within bracket for the first year. Full stop. Only for the first year of convergence this happens. This amount shall be added or reduced. This amount shall be added or reduced from the book profit. From the book profit across 5 years. Across 5 years. Across 5 years. That is 1/5 every year. 1/5 every year. Next point. From the transition amount, any foreign exchange fluctuation on account of revaluation of PPE, that is, we have discussed what PPE is, or revaluation of equity instruments, shall be excluded if they are included in the transition amount. Why? Because that is separately done only at the time of sale. Here, the same thing I have given here. See, transition amount adjusted in other equity, excluding capital reserve and security premium account on convergence date, but not including the following. This one. Ind AS 16 and 38, equity instrument, all that you have to adjust. Property, plant, equipment, investment in subsidiaries, and all these things. So basically, guys, in this particular case, what I should do, 1/5 of the transition amount I should add, and 1/5 of the transition amount I should subtract accordingly, depending on whether it is a profit or a loss. Then apart from that, it's the same. This is in compliance with Ind AS, then the tax surcharge, then it remains the same. Apart from that, other points are already discussed, including the MAT credit. This one we had already done in international taxation. Kindly recall. If there is an increase in the book profit due to advance pricing agreement or secondary adjustment, section 154 rectification should be done. We had seen this already. Refer international taxation discussion. See here. What all I should subtract from here, guys? Transition amount means adjusted in other equity excluding capital reserve and security premium account on convergence date. But it will not include the following. One is amounts adjusted in other comprehensive income, revaluation surplus under Ind AS 38, equity instruments, property, plant, equipment, and other intangibles, all these things. Once you do a sum, you will understand. They had given it in May 2018, if I am not wrong. Come to the compiler, R7. Compiler, R7. Alpha and Beta Tires Limited, Indian company engaged in the manufacture of tires in Andhra Pradesh, had adopted Ind AS from 1/4/2017. The following particulars are provided for the year ended 31/3/2023. Net profit as per statement of P&L account is 20 crore after debit and credit of the following items. Items debited, depreciation 18 crore. Included in depreciation is 3 crore being amount provided on revalued assets. Will you take that? No. Interest charged for delay in remittance of tax creditors, source 20 lakhs. Should you take interest? Is it part of the amount of tax payable? What do you think? Share of income from AOP 50 lakhs. AOP is charged at MMR. Amount of 6 crores withdrawn from revaluation on account of revaluation of asset. Application of a financial creditor for CIRP has begun, admitted in the Hyderabad bench. Guys, if that be the case, what had we seen in the previous class? Business loss and depreciation, whichever is less, generally you should take. But when this NCLT thing comes, I should add everything and take. See here, this is that part which we did now, Ind AS part. Items credited to other comprehensive income will not be reclassified to P&L account. Remeasurement of defined employee retirement benefit 50 lakhs. Revaluation surplus of property, plant, equipment 1 crore. Transition amount as on convergence was 5 crore including 50 lakh. Should I take that 50 lakh? No. You see, net profit as per P&L account 20. Here 20 crore. And I should add the full depreciation first 18. Interest in delay of TDS, yes, that is part of, very much part of the, tax payable, that add less what? Share of profit from AOP. We gave the logic. For partnership firm, they reduce, but what about AOP? Have to reduce. Amount of depreciation debited in statement of P&L account, excluding the depreciation on revaluation of assets. So it is clearly they had mentioned here. 18 crore, 3 crore was revalued asset. So I have to subtract 15 crore. Then revaluation also have to subtract 3 crore. Accumulated loss, add everything. 3 plus 5 plus 1 plus 2. Otherwise, I should have added this 8 or 3, whichever is lesser. Then I should have taken 3. Now it is what? 3 plus 5 plus 1 plus 2 because it has gone through IBC. So here 11 I will subtract. Book profit before Ind AS adjustment. Items credited to OCI. As I told you here, all items credited to OCI and not be reclassified to P&L account. Since it cannot be reclassified, to align it, I have to add back. So 50 lakhs I will add. Next. Guys, I told you, what about the second one? Revaluation surplus of property, plant, equipment 1 crore should not be taken now. It should be taken at the time of disposal. Not to be taken now. Ignore. Transition amount of convergence 5 crores. 5 crores minus 50 lakhs 4.5. 4.5 1/5. 1/5 of 4.5. That is 90 lakhs here. Then MAT, surcharge, all these things. MAT, this ultimately this will come. Tax payable is 1.77. Normal 15% of MAT this month. Normal provision this one. Ultimately MAT credit. Very simple. See guys, 6 marks question, easy. So I hope you are able to understand MAT. When MAT is for individuals, sorry, MAT is for companies who have opted for 115 BAA, BAB. If they have opted for that, MAT will not apply. For others, those who have not applied, what do you say, opted for 115 BAA, BAB, what will come? AMT. For companies, I repeat again, scratch everything, I will coolly repeat, MAT will apply for companies. Second, if companies have opted for 115 BAA and 115 BAB, where lesser taxation was given, MAT will not apply. So none of the MAT provisions will apply there. You cannot take MAT credit, nothing. On the other hand, for other than companies, that is for individuals, AOP, etc., we have AMT, alternate minimum tax. Very, very easy it is, AMT. Alternate minimum tax, AMT. Applicability, computation of amount. So guys, AMT is very simple. This is for other than companies. If you have opted for 115 BAC, the new regime, then AMT provisions will not apply. Same like companies only. For companies it is BAA, BAB. Here it is BAC. So here the problem is, I have looted money from the companies through MAT. Government is telling I will take extra. Basically, whatever you deserve, because you are earning, because of various deductions, etc., you are making the income less, I will take a minimum alternate tax of whatever, 15%. On the other hand here, I will make the adjusted income. So I will add, here government realized that you will be taking 80 IA to 80 RRB. These things, if you take, I'll have to, probably your income will be so less that you don't have to pay tax. I'm not agreeable to this. I have to charge you something. So, but if you do for cooperative societies ATP, that you exclude, except ATP, other things. I will add. Then if you have taken any deduction under 10 AA, I'm sorry, I will add that also. Third one, if you have taken any deduction under scientific research, that also I will add. But if you have not taken scientific research, 35 AD, but you have taken depreciation and additional depreciation, that I will subtract. So this will be my adjusted total income. That's it. That is AMT. So they are only concerned about these things. 80 IA to 80 RRB, 10 AA, 35 AD. If you have considered 35 AD, this. If you have not considered 35 AD, then this. Depreciation and additional depreciation will come. This adjusted total income, if it is, if your tax on normal provisions or 18.5% of adjusted total income, whichever is higher. And if you pay as per AMT provisions, you will get AMT credit. Just like MAT credit, you will get AMT credit. Very simple. Right? So tax. And here it is ATI. On the other hand, if the adjusted total income is 20 lakhs, less than 20 lakhs, then they'll be like, leave it. AMT will not apply. We'll see everything. This is the gist of the story. That's all. Let's check. One second, guys. Cool. Check it out. Page T.1. Page T.1. Sorry, guys. Yesterday I couldn't sleep only. So today, little, eyes are closing off. But don't worry, right? That happens to all of us, are human beings. For me, no, people ask me, sir, do you edit your videos and all that? I said, I want to be raw. As you see me, that's how I am. I don't want to edit, add masala and all those things. Generally, I don't have an editor also. Actually, now I have to buy because I need to cut videos and post it on YouTube. Generally, I record and post the entire thing. So many people ask me that, do you have any editor? Which editor do you recommend? When I say no, they'll feel baffled. They're like, this fellow is lying. I genuinely don't have. Now I have to purchase one editor in the sense editing software, because I don't edit. So people will be like, when I talk to students, other faculty members, when I talk to students, I'll cut that. Sometimes, sir, I yawn in class, I cut that. For me, nothing. It is raw. What you see is what you get. It should be like that, no, guys. So because of yesterday not getting any sleep, I'm feeling little sleepy. Mind is very alert, but feeling sleepy. So I yawn. No problem. But people know they edit this video. I don't want to. First of all, time waste. Second is, we are all human beings. Come on. You also, how many times I can see from here, how many times I've slept when I'm taking class. Morning you'll be seeing, and slowly you'll be like this, correct? All happens. Okay? All in the game. Yes. So, let me on off 1 second. Thank you, guys. Yeah. On. Mind is superb. The beauty of the mind is everything is here. That will be alert. But then physical lethargy will be there, right? Anyway, guys, come on. So AMT credit, what is it? Provisions of section 115 JC dealing with alternate minimum tax shall apply in respect of all SSEs other than company. So AMT shall apply to individuals, firms, LLP, BOI, all these things. Alternate minimum tax means the amount of tax computed on adjusted total income at the rate of 18.5% or 9% as the case may be. For every assessment year, two parallel computations are required. One is under normal tax, one more under AMT. And I have to do what? Whichever is higher. Applications of AMT to certain persons. Certain persons. So as I told you, the provisions related to AMT shall apply to any person who has claimed any deduction under ATIA to section RRB except ATP, 10AA and 35 AD. So provision related to AMT shall apply to any person who has claimed any deduction under ATIA to ATRRB, 10AA, 35 AD. Provisions of AMT shall not apply, as I told you guys, individual, HUF, AOP, BOI, artificial juridical person. Mind you here, very interesting to know, partnership firm, LLP, no exemption. Here if you see, AMT will apply to all. But here they are telling if the adjusted total income does not exceed 20 lakhs, AMT shall not apply. So if there is a MCQ question, they'll ask a partnership firm, their total income, adjusted total income is just 20 lakhs. Will AMT apply? 100% yes. 19 lakhs, will AMT apply? Yes. Individuals or HF, if such person opts for alternate tax regime under 115 BAC. Cooperative society under BAD. So compute this. Step number 1, compute as per normal tax provision. Step number 2, deductions under this one, depreciation, same 18.5%, no change. In case a person other than a company being a unit located in an international financial services and which derives its income convertible foreign exchange, the alternate minimum tax shall be 9%. So if you are a foreigner investing in a unit located in IFSC, then how much guys? 9% instead of 18.5%. The person who is liable to AMT shall furnish along with the return of income report from the chartered accountant certifying that the adjusted total income and AMT are in order. All other provisions will apply guys, no change, no certain change like that. Tax credit, AMT, tax credit. The AMT to the extent it exceeds tax as per normal provisions are available to the credit and can be set off within a period of 15 assessment years. Similar to that here. If AMT is greater than normal income tax, excess is AMT credit. Credit can be set off in the year in which tax as per normal provisions is more than the AMT. Credit set off cannot exceed the difference between normal income tax and AMT. Brought forward AMT shall be allowed to set off in a previous year even if, this is one interesting thing. What had happened was this was inserted by Arun Jaitley. Because guys, for example, let's say you're an individual, okay? So you have claimed ATIA for assessment year 2021. That is your last year of claiming. AMT is 10 lakhs. Regular tax is 1 lakh. So 9 lakh is what? 9 lakh is your tax that you have to pay under AMT. No problem. You will pay 9 lakhs extra. Apart from that 1 lakh, 9 lakh extra. That is a credit now you are getting. Next year, what happens is ATIA gets exhausted. Can I do this credit? Can I have this credit? Ideally, no, because it says that the wordings of the section are such that AMT credit will not apply if you what do you say? See, what is the applicability of AMT? Only if he has claimed any deduction. The next year, as I told you, have you claimed any deduction? No, it got exhausted. Got exhausted. Have not claimed any income, what to do then? Problem. Correct? Problem. On the other hand, AMT will apply if does not apply if it is less than 20 lakh. Let's say this year mine was 40 lakh. So I've claimed AMT. Next year my adjusted total income is coming up to 10 lakh. So AMT will not apply. But can I carry forward the credit? Big problem was there. Litigation happened. Arun Jaitley inserted one dialogue. That dialogue is point number D. Brought forward AMT credit shall be allowed to be set off in any previous year, even if the assessee has not claimed any deduction at NA 35AD under Chapter 6A, and then adjusted total income does not exceed 20 lakh, both the cases. So he inserted a line, 115 Jade. Let me see, I'll show you that wordings. Nice wordings it is. IIT JE, no, this is 115 JE. Here, this was inserted by Arun Jaitley. 2014, when BJP came to power, one of the first things that they inserted was this. Notwithstanding anything contained in subsection 1, subsection 2. Subsection 1, 2 is talking about applicability of AMT. Credit for tax paid under JC shall be allowed in accordance with JD. It will be allowed as per this is JD. 1910, tax as per normal income tax provisions 5 lakhs. AMT 8 lakhs. A or B, whichever is higher, 8 lakhs. So what is the credit that I am getting? 3 lakhs. AMT credit, this is set off. Any set off? No. Actually paid 8. AMT credit balance 3 lakhs. 7 lakh, 9 lakh. I will pay 9 lakh. Extra 2 lakh credit. 3 plus 2, 5. 8 lakh 50, 5. I have to pay 8 lakh 50. But 3.5 lakh, can I claim credit? Yes. What is the balance? 5 minus 1.5, 3.5, 1.5. 7 and 5. How much I'll pay? 7. So 2 lakhs, can I, what do you say? 7 lakh I'm paying. So 2 lakhs, can I withdraw? Yeah, but then I don't have 2 lakhs. 1 lakh 50 I can withdraw here, set off. So remaining I have to pay 5 lakh plus extra 50,000, 5 lakh 50. Next year 7 lakh and 8 lakh. So here I'll get 1 lakh extra credit. Next year 6 lakh 50,000 AMT is nil. Still I can claim this 1 lakh, no problem. This was as per the Arun Jaitley's change that happened. Where the tax payable is increased or decreased as a result of an order, AMT also will be changed. Just like MAT, SSE is not entitled to any interest or AMT credit. Where an SSE is entitled in a foreign tax credit under 90, 90 and 91, it is allowed against AMT, then FTC exceeds FTC admissible against tax payable. The normal provisions, the excess FTC can be ignored. Guys, same thing we have done in international taxation. So you can say refer international taxation lectures. That's about it. That's about AMT. Come to page P1, my dear friends. P1. Amalgamation. If you remember, we have done everything. So if a company, Brook Bond, amalgamates into Hindustan Liver, we have seen depreciation will be calculated and depreciation will be shared based on the number of days. At various junctures, we have already covered amalgamation and demerger and all that. Nothing to cover. Just quickly we have to revise, that's all. Then if you remember, any unamortized will be unamortized expense 35D will now shift to the, this is called amalgamating or TED company. What is this called? Amalgamating company. This is amalgamated company. So 35D unamortized value will go to the amalgamated company. Telecom license, ABB, if you remember, that will also go to the other company. Spectrum, 35 ABA, that also will go. Expenses of amalgamation, 35 DD, 1/5 will be transferred. Capex, 3619, if you remember, family planning, that also will be transferred. Voluntary retirement scheme, 35 DDA. Voluntary retirement scheme, 35 DDA, that also 1/5 will go. All other AT, IB, IC, IE, that also will go to the other person. If there is any bad debt, we saw a case law, Veerabhadra Rao, see 8, 9, 10, 11, 12. Bad debt, Veerabhadra Rao case. High Court told that the amalgamated company also will get the, what do you say? We can claim that expense. Bad debts recovered, 41(1). We saw it is taxable. The law was amended and taxable in the hands of the bad debts recovered, and 41(1) taxable in the hands of the amalgamated company. All that we have seen, guys, same thing I have given here. And when the amount is sold, shares are distributed, capital gain is exempt, and only when you sell it, obviously then it will come to you. Even if you are an individual, you get 5 shares in exchange of 4 shares in this company, whatever it is, that is exempt. At the time of your selling, then it will come. Cost of acquisition of the previous owner, or rather from you only, you are the previous owner, basically whatever cost you are there in the previous company, let me say like that, then it will come. Always amalgamation, it should take the approval of what? High Court. So if you sort of try to do a merger without High Court approval by transferring all the assets of one company to the other assets to the other company, by distribution of property of one company to the other company, it will not be called as amalgamation as in this section, because you have not gone through the High Court route. According to 2(1)(b), amalgamation in relation to company means merger of one or more companies with another company, or merger of 2 or more companies to form a new company. Merger of one or more companies with another company. This is also, one or more companies with another company. Vodafone plus Idea. Or one company, Reliance, taking over one more company, Tesseract. Merger by absorption. Or it could also mean 2 companies coming together to form a brand new company. The company or companies which so merge is called amalgamating, and the other company is called amalgamated. Merger will be treated as amalgamation only if the following occurs. These 3 conditions also we had discussed. Again we'll repeat, it's just a revision, already we have done. All the property of the amalgamating company should become the property of the amalgamated company. All the liabilities of the amalgamating company or company should become the liabilities of the amalgamated company. All property, all asset liability shifted. Now, third point, shareholders holding not less than 75% in value should become shareholders of the amalgamated company, because special resolution should be passed. But guys, Reliance wants to take over Tesseract. Reliance already has 20%. Now they're amalgamating. So basically, when they say shareholders of this company should be shareholders of this company, 75%. But the thing is, Reliance is already a shareholder. So should I take 75% of overall or 75% of the balance? Obviously 75% of balance, 80%. That's what it says. Doesn't make sense. You cannot allot shares to yourself. You are not Swami Nityananda. Me, allotting shares to me through the company which is framed by me, not possible. So, shareholder not holding not less than 75% in value, the share should become shareholders of the amalgamated company, other than those shares already held immediately before the amalgamation by the amalgamated company, its nominee, subsidiary, whatever. If you see here, A Limited is amalgamating with B Limited. B Limited holds 20% of shares in A Limited prior to amalgamation. For the purpose of above clause, the shareholders holding 75% or more of shares in value out of the 80% of the shares should become the shareholders of B Limited. Capital gain, as discussed already, guys, as per section 47, where shareholders are allotted with shares of the amalgamated company in exchange for shares of amalgamating company, does not amount to transfer. Hence, there is no capital gain. It will arise only when they are selling the shares. We have done this in depth in capital gains. Cost of acquisition of shares in the amalgamated company is the cost of acquisition in the amalgamating company. Period of holding will be from whatever it was there in the amalgamating company. Capital gains for the amalgamating company. There is no capital gains on transfer of capital asset by amalgamating company to amalgamated company. What is the capital gains for amalgamated company? All the assets become the property. Cost of acquisition is cost to previous owner. Period of holding includes the period of holding to previous owner. This is for the amalgamated company. This same thing I see. Expenses incurred for amalgamation shall be allowed over a period of 5 years in equal installments. 35DD. Reduction under 35 ABB, 35DE available on amalgamating company can be availed by the amalgamated company in the same manner as if the amalgamation had not taken place only. Same with 80IB. Kindly recall all these discussions. We had done everything there in the respective cases. But third point is not something that we have not done. We have just explained briefly but not done. Losses and unabsorbed depreciation of the amalgamating company shall be treated as that of the amalgamated company. The best part, why people go for amalgamation? 8th year, generally carry forward is allowed for 8 years. 8th year I amalgamate, the new company will get fresh period of 8 years. This is for loss. Unabsorbed depreciation can be carried forward indefinitely, as you know. As you know, it can be carried forward indefinitely. So if you come to set off and carry forward, page G6, we will finish it off here. This is for these companies. Fresh value for these companies. Accumulated loss and unabsorbed depreciation in amalgamating company is deemed to be the loss and unabsorbed depreciation in amalgamated company. Fresh 8 years. You will get fresh 8 years. Whereas unabsorbed depreciation unlimited only for these companies. First one, where there has been amalgamation of company owning an industrial undertaking or a ship or a hotel. Industrial undertaking or a ship or a hotel. So there were large, small undertakings who were doing business, but then the thing is they could not compete with Tatas, Birlas, Mafatlal, Singalias. So the bigger fish absorbed them, and they did it with one purpose. Once I amalgamate, their losses will come to me afresh. These are all industry demands, and government has, agreed to that industry demands. Similarly, ship. Many small shipping businesses are there which have been absorbed by these bigger shipping industries. Same thing. Hotels. Many hotels are there which will not run. So the thing is, a better management will come and take over some 5-star hotel. So all those hotels which were running under loss will now be profitable. But nevertheless, there was a hotel called Orange County, for example. Orange County was taken over by Evolve-Back. If you see website of Evolve-Back, you will know. Per day, it's some 50,000, 60,000 rupees per day. So it's like that. So a company owning an industrial undertaking or a ship or a hotel with another company, or a banking company with a specified bank, SBI or its subsidiary. So if you remember, all the, banking companies came under this. Banking company, it merged with one more specified bank. If you remember, Allahabad Bank, Bank of Baroda, your Syndicate Bank merged with Canara Bank, if you remember. All these things came under this. One or more PSUs with one or other more PSUs. So during that time, Air India, Indian Airlines used to be there. Indian Airlines merged with Air India under this. And not recently, it's been a few years ago, couple of years, Tata's took over Air India. Will that come under there? No. One PSU it is, but the Tata is not a PSU. For that, Finance Act 21 added this, guys. An erstwhile PSU, Air India, with one or more companies, if the share purchase agreement entered into under strategic disinvestment, this is the, Narendra Modi's one more policy, strategic disinvestment. Restricted amalgamation of the said public sector company, and amalgamation is carried out within 5 years from the end of the previous year in which restriction in the above share purchase agreement ends. So this is a classic example. This was inserted purely for what? Tata Air India. Tata said, bro, I will take over, but all your losses, you give me 8 more years. No, otherwise, why will I take over? So they changed the law for Ratan Tata. The shares of PSU are purchased by B if, as per the agreement, the strategic disinvestment, companies cannot amalgamate till assessment year 31/3/2026. Losses and as on 31/3/2026 shall be the losses and unabsorbed depreciation once the amalgamation takes place. So here also in Tata there will be a share purchase agreement for a couple of years, and then things will go ahead. So this is all the share purchase agreements. There are certain conditions also, guys. Let us see those conditions. So there should be a sale of public sector company to a normal company. So here you can actually, shares of Air India are purchased by, remove the PSU, are purchased by Tata. So the share purchase agreement will say 2 years amalgamation will not take place. So when will the restriction end? 2 years later. So from that, you should carry out the amalgamation within 5 years. That's the condition. And then all the provisions of amalgamation will apply. But you see, there are conditions to be satisfied by both. Only then it will apply. Otherwise, no. First one. What is erstwhile public sector company? Means a company which was a public sector company in earlier years and ceases to be this because of strategic disinvestment. Air India, classic example. Strategic disinvestment means share of shareholding by the central or state government in a public sector company which results in reduction of its holding to below 51%. Same Air India. Accumulated loss and unabsorbed depreciation of the amalgamating company, which becomes loss of the amalgamated company, shall not be more than the accumulated loss of the public sector as on the date on which such company ceases to be a public sector undertaking. Shall not be more than the accumulated loss. Basically, let us say on 1/4/2021, this is the date when the disinvestment happened. The losses were 80,000 crore. Share purchase agreement said 2 years you cannot do anything. As on 31/3/2023, 2 years later, still amalgamation has not taken place. Losses are still there. Loss has become 1 lakh crore. Now tell me, guys, will you take 80,000 crore or 1 lakh crore is what they are asking. Accumulated loss and unabsorbed depreciation of the amalgamating company, Air India, which becomes loss of the amalgamating company, Tata, shall not be more than accumulated loss of the public sector company as on the date on which company ceases to be public sector company, 80,000. So you cannot use amalgamation as a tool to increase the losses and take over extra 20,000. So Tatas cannot make a scam whereby 2 years they'll not work only on Air India, thereby increasing the losses to 1 lakh crore, then takes over the company because the share purchase agreement ends, And then Jingalala for them. What? 1 lakh crore. Continuous 8 years. Good provision. Good provision by Nirmala madam. Yes. Conditions to be satisfied by the amalgamating company. Amalgamating company should have been engaged in the business for 3 or more years. So basically it should not be a new company. Amalgamating company should hold at least 3/4 of the book value of fixed assets on the date of amalgamation as it did 2 years prior to the date of amalgamation. As it did 2 years prior to the date of amalgamation. 75% of the book value of assets they should hold. So, for example, book value as on 2018, book value as on 2021. Asset A, B, C, D, E, whether these are the book values 50 lakh, 40 lakh, 20 lakh, 30 lakh, 60 lakh. Here only B, C, D are there. So here how many? 100, 150, 200 lakhs. Here B 30, C 15, D 25, E 45. Let's say 115 lakhs. So does it mean that 75% of 200 should be there? 150 should be there. 150 is not matching to 115. Wrong. No. No. What does it say? Read again, guys. The amalgamating company should hold. Amalgamating company, that is the first one. Same, amalgamating company only should hold at least 3/4 of the book value of the fixed assets on the date of amalgamation. This is the date of amalgamation. As it did 2 years prior to the date of amalgamation. So 20, I'll make this 20. 2 years prior. What they are trying to tell? 3/4 of the book value of the fixed assets on the date of amalgamation as it did 2 years prior to the date of amalgamation. So, here what they are trying to tell, guys, this reduction in value is due to depreciation, right? Nothing else can happen apart from some sale here and there, that's okay. So you see, what they are trying to tell is the book value as on the date of amalgamation of the same assets which are there here, B, C, D, E, block, B, C, D, E. The book values of these assets, 1 for 100, 150, 150. The book value of the assets should represent 75% of the assets as on that day. 150 by 200 is 75%. That 75% of 200, 150 by 200 is already represented on 2018. Is it continuing here? Yes. That's all. This reduction in value obviously is because of depreciation and other things. The book value of the assets as on 2020 is of no relevance. That's the important point. The book value as on 2020 is not at all relevant. What is relevant is 2018. Those assets which were there 2 years ago, were they representing 75%? The answer is yes, then same thing will continue here. Got it? For instance, in this only D and E are remaining here. 90 by 200, was it representing 75%? No, not representing 75%. So if you see, amalgamating company should hold at least 3/4 of the book value of assets on the date of amalgamation, as it did 2 years prior to the date of amalgamation. This is the date of amalgamation. Is it representing 3/4 of the assets? Yes, it is. In fact, if you see here, BCDE full 100%, 115 it is, because A is not even there. If you think about it, that is what you need to see. Got it, guys? Hope you understood this. I repeat, it is book value as on 2020 is of no relevance, because what has to be seen is what? Fixed assets which constitute 75% of the book value on the, that is 2 years ago, should continue to remain. That should continue to remain. The asset should continue to remain, because the reduction in value is due to what? Various things. But the book value should be compared as on the date of amalgamation. Nothing else is what they are trying to tell. Conditions to be satisfied by amalgamated company. Now, the amalgamated company should hold at least 3/4 of the book value of the fixed assets continuously. Earlier only assets were there. Then assets will include stock, etc. Dangerous. That's why they made it fixed assets. Who will keep stock for 5 years? Continuously for a period of 5 years from the date of amalgamation. Amalgamating company. Business of the amalgamating company should be continued by the amalgamated company for a minimum period of 5 years. Can't change the business. Amalgamated company fulfills additional conditions as prescribed in rule number C. Means what? Production of at least 50% of the installed capacity before the end of 4 years from the date of amalgamation. Continue to maintain the same 5 years from the date of amalgamation. Amalgamated company duly verified CA certificate. If any of the above conditions are not complied with the set of loss, etc., in any previous year in the hands of the amalgamated company, shall be deemed as the income of the amalgamated company. Whatever loss you claimed set off, that set off will not be allowed. It will be deemed to be income. And guys, it is only talking about business. Speculative loss of the amalgamating company cannot be carried forward and set off by the amalgamating company. This should be amalgamated company. Right. So if you see, guys, what does it say here? Industrial undertaking. What is industrial undertaking that they have defined here? See, manufacture or processing of goods, even software. People could not match up to Infosys, etc. They were eventually taken over by other companies. That's what it is. Generation and distribution of electricity. Telecom services. Remember, you had this Spice, Aircel, Orange, everything wiped out because bigger players came and amalgamated because of this only. They said, if you don't add telecom here, I will not take over. If you don't take over, then that's it, over. You will, I'll not get that benefit, right? Excuse me. Excuse me, guys. Whether basic or cellular. Earlier, we used to just sneeze like that. After COVID, after 2020, we have now understood that you have to sneeze like this. All those things. Yeah. Earlier, when we were coughing, sneezing, people were telling, bless you. Now, when we cough or sneeze, people will tell, bless me. Why? Because if I cough at you, you have to bless yourself. Otherwise, all that, Corona, COVID. Right. Sir, we are sitting and just seeing your stupid face. We are not face to face, thank God. Right? Whether basic or cellular, including radio paging, domestic satellite, all these things, guys. Mining, ships, aircraft, railway systems, all these things are there. Railway system, anyway, now privatization is what they are planning, government, but IRCTC is the dominant monopoly. That's about this amalgamation, guys. As far as amalgamation of foreign company is concerned, transfer of shares in an Indian company in a scheme of amalgamation by amalgamating company, it's exempt, subject to following. At least 25% of the shareholders of the amalgamating foreign company shall continue here. Special resolution thing because of that. Such transfer does not attract capital gains in the country in which the amalgamating company is incorporated. This you have also seen in international taxation. Yes, transfer of shares in a country which derive its value directly or indirectly in Indian company scheme of amalgamation. This was our classic example of, Vodafone. If you remember, in international taxation, we did this. So that is about amalgamation. So just write down here the losses of amalgamating company under first one capital gain, second one house property, third one owning and maintaining race horses, fourth one speculative business. Here no speculative business we saw, there only you can add off. Not here, sorry, in the set of speculation loss. Not just that, capital gain, house property, owning and maintaining race horses. Because guys, only they speak about PGBP here, nothing else. So those things will not come into the picture. So come to this in the set of carry forward. See, set of carry forward, we have done this part because it was linked to amalgamation. Then we are doing 72A4, we'll do it after demerger here. 72AA. Amalgamation in the case of one or more banking company with one or more banking institution under a scheme sanctioned by central government. So example guys, Global Trust Bank amalgamated or was taken over by Oriental Bank of Commerce because there was a scam by the promoters so many years ago. Yes. In that case, tell me, shareholders of the old company, promoters only did scam. They will be shareholders of this Oriental Bank of Commerce? No. That's why special section. Those provisions will not apply, no problem. One or more new corresponding bank with another bank. This is nationalized bank. PNB. Actually, OBC also was taken over by PNB. PNB took over OBC. Indian Bank took over Allahabad Bank. Canara Bank took over Syndicate Bank. Union Bank of India took over Corporation Bank and Andhra Bank. All these are examples of that. All that came under 72AA. One or more government company with another government company. Government company is taking over. Loss and unabsorbed depreciation shall be deemed to be the loss of amalgamated company for the previous year in which the scheme was brought into force. These are special provisions. None of the other conditions need to be fulfilled for this. No problem. Even if you don't fulfill the conditions, it is absolutely okay, is what this section says. Next, demerger. Guys, for example, demerger. Why do people go for demerger? It is for better economies of scale. So ABB, as I told you, they demerged into ABB Power. Siemens was one company into this electronics, etc. Siemens Electronics. They had a telecom business also, which was incurring a loss. So if a profitable business and loss business comes together, then obviously the loss may overshadow the profit, right? That's why they enter into something called as, what do you say, demerger, whereby they will demerge. It could be a profit-making entity also, but for better economies of scale and better control, they will demerge. So for instance, if you see Reliance Jio Infocom, they demerged into two. Through a slum sale, they went into this Jio Infratel Private Limited. This is one company where this is only about towers. And one more company was Geo Digital Fiber Private Limited, resulting company. Demerged company was Reliance Jio Infocom. So predominantly it got divided into three companies. One is Reliance Jio Infocom was the demerged company. Then two companies, Geo Digital Fiber Private Limited, only concentrating on fibers. Then of course your tower infrastructure company, Reliance Jio Infratel Private Limited. So demerger is a strategic reconstruction, strategic decision, so to speak, in the larger scheme of things. So coming to our thing now, page P2, demerger. So as per 219AA, demerger means transfer of an undertaking. An undertaking can be a branch, can be a unit inside that by the demerged company to the resultant company. Same guys, all property transferred at book value should be the other companies, should be transferred at that rate. Revaluation from the beginning, revaluation should be ignored. Revaluation will not be taken into account. All liabilities also will be transferred. The properties and liabilities transferred shall be transferred at book values appearing in the books of accounts immediately before merger. So if the resulting company records at different value, the same shall be considered as Ind AS. Ind AS, whatever we did, the similar provisions will apply. So that is what they are trying to tell. The resultant company issues its shares on a proportionate basis to the shareholders of the demerged company, except where it is same thing. So I will issue for every 3 shares, I will issue 2 shares. But if I only held shares in you, that will be ignored. Then see, same thing. This is copy pasted from merger. Shareholders holding not less than 75% of shares in value agree to become the shareholders of the resultant company. Transfer of undertaking is on a going concern. In this regard, transfer of capital asset in a demerged company, the resulting company is not regarded as a transfer. So if my company, transfers some assets to your company, in this example, when both the companies shall issue equity shares to Reliance Jio Infocom, and I will demerge into this, and I am issuing shares here, it is not a transfer, is what they are saying. Transfer of capital asset in a demerger by the demerged company to the resulting company is not regarded as transfer. The resulting company is an Indian company. Similarly, transfer of shares by the resulting company. In this example here, this is the resulting company. Transfer of shares here. Transfer of a capital asset. All the assets were transferred here. This is not a transfer. Similarly, this is not a transfer. Geo Digital Fiber Private Limited issuing shares to Reliance Jio Infocom is not a transfer. Practically, I am teaching you. So capital gains also same thing. There will be no capital gain in the hands of the shareholder, the demerged company, when they receive shares of a resulting company. Period of holding, same, includes the period which the asset was held as a demerged company, same, no change. Cost of acquisition will be the same as before, but of course, here cost of acquisition, what will I do? I will take the net book value. Net book value of the assets in a demerger divided by net worth of the demerged company immediately before demerger into cost of acquisition in the demerged company. Cost of acquisition in the demerged company will be the original shares minus whatever was obtained above. Capital gains will be for the resulting company will be the same thing. Cost of acquisition will be the cost of acquisition of the assets in the demerged company. We have seen everything in capital gains already. Nevertheless, check the example here. Mr. Naveen is a shareholder in D Limited holding 1000 shares which were acquired for a consideration of 12 lakhs. D Limited transfers the assets and liabilities of one of its undertakings to R Limited. In consequence of such a demerger, Naveen is issued certain shares of R Limited in lieu of certain shares held in D Limited. You are informed that the book value of the assets transferred is rupees 175 lakhs. Book value of liabilities is 75 lakhs. Paid up share capital is 400 lakhs and general reserve is 100 lakhs as appearing in the books. To calculate what is the cost of acquisition of original shares held in D Limited, 12 lakhs. Net book value of assets which have been transferred, that is 175 minus liability. Net asset will be 100 lakhs. Net worth of D immediately before demerger. What is the total value? 400 plus 100, 500. So basically 100 out of 500 is what is transferred. 1/5, 20% is transferred is what they are saying. Cost of acquisition will be what, guys? This 12 lakhs is for the full company. What is the part which is demerged? 100 out of 500, no, 20%. So 20% of 12 lakhs, that is 2.4 lakhs is the cost of acquisition in R Limited. The cost of acquisition in D Limited will be the reverse, 12 lakhs minus 2.4%, basically 80%, that is 9.6. Hence, cost of acquisition in the resulting company is 2.4 lakh and the other one it is 9.6 lakh. Overall making it 12 lakh. That's all. And all these points are copy pasted from amalgamation, no change. This also no change, this also no change. Here instead of 25%, is 75% value shares. That's it. And if you go to this set off and carry forward, same copy paste. Where loss is directly relatable to the undertaking transferred, fully allocated to the resulting company, it is not directly relatable, apportioned between the ratio of assets retained and transferred. So in this example, if something related only to geo fiber related stuff, full loss will be allocated there. Otherwise, they will share between the as per the assets. That's it. Speculation loss cannot be carried forward. As far as the depreciation is concerned, if you remember, page B19. We had seen this that time. Again, we'll do explanation 7A to 43.1. Explanation 7A to 43.1. And if you remember, guys, distribution of assets to people, generally there is deemed dividend under 222, but we have seen for demerger, it is not a deemed dividend. All that we had discussed, guys, just a revision. But here, explanation 7A to 43.1. Asset transferred by a demerged company to resulting company, actual cost to resulting company is the WDV of the demerged company. WDV of the demerged company. So in pursuance of a scheme of demerger, B Limited was the resulting company. AB Limited. So if you see in the case of a demerged company, WDV of the block of assets in the immediately preceding year shall be reduced by the written down value of the assets transferred to the resulting company. Pursuant to scheme of demerger, B Limited was the resulting company. AB, the demerged company, transferred an asset. Only asset in the block whose opening WDV was 10 lakhs. Demerger took place on 1/8/2008 and the rate of depreciation of 15%. In case total depreciation for the entire year will be 10 lakhs into 15%, 1,50,000. Now this has to be, what do you say, distributed between the two companies on the ratio of the days. It happened on 1/8/2022, right? So the demerged company, it will be from 1/4/22 to 31/7/22, this depreciation. It is in this rate, and for the resulting company, this rate. Actual cost of the resulting company is what? WDV of the demerged company. So what is that given here? Total depreciation is 10 lakhs. The entire 10 lakhs, the only asset in the block is transferred. So for them, it is 10 lakhs minus whatever was held by the demerged company. So for the resulting company, actual cost will be 9,49,863. This we had also discussed during PGBP. We are just revising. That's about it, my dear friends, with respect to demerger. Then we'll see if there's anything else has to be done. We will see it in the next class. So in my opinion, 2 to 3 classes, that's it. Small classes of like 1 hour each, 1.5 hours each, as usual. We'll finish it off. Only miscellaneous provisions are left here. Everything else we have covered in depth. So these things just go through like this and go. Solve the previous year's question in the compiler. And if possible, I will also record 10-15 hours of Q&A solving and include it here, or I'll put it up on YouTube. Okay, I will try my best. Okay guys, keep solving, buddies. So income tax, DT and international tax are quite easy. Just need to keep revising. Okay, cheers.